GETCRACK. Wake up, motherfucker.
What would it take for you to change your mind? What would it take for China to be investable?
Well, look, I'm obviously never the person
Are you
to ask that
just
question
not
to.
liking China at all? No matter what China does, you're not going to like it. I mean, is that a fair assumption to make? Is that the real picture when it comes to custom block and China?
Well, I've always considered that the domestic equities were different from a governance perspective than the offshore equities, particularly the U.S. equities. There was always more recourse. The heads I win, tails I don't lose equation doesn't necessarily exist with domestic onshore equities. So that's something that we haven't looked at before. But if you're looking at buying Chinese equities in the U.S., that governance risk is always there. I don't believe the numbers. I do trust the numbers, or much more likely to trust the numbers onshore. But at the end of the day, China, in contrast to, say, Vietnam, which we are very constructive on, doesn't feel like it really needs foreign capital. And I don't think it intends to be accommodating to foreign capital on a long-term basis.
Okay, let's talk about the U.S. Overvalued, some say. We've seen, 47 straight sessions of record, and the most expensive in decades. Is that something to be concerned about?
Well, there's a debate as to what really drives, when you talk about the U.S. market, especially the S&P 500 or the Mag 7. I'm in the camp that, although I don't have the facility with math to really try to prove this out, but I'm in the camp that believes that what drives that index are flows. And so at the end of every month, U.S. workers, a lot of them, their paychecks go into their 401ks, which are retirement funds, and there's a robo bid for these stocks. And what happens is you reduce the effective supply of stock because you're taking out the active owners of stocks that will decide, hey, at this price I'm a seller, at a lower price I'm a buyer, and you're replacing that with a holder that will never sell unless and until it has outflows because people are drawing down their retirement accounts. So according to that view, as long as the labor market is reasonably strong in the US, which it is, you're not going to see outflows. You're just going to continue to see inflows, especially in those, in the most heavily weighted names in the S&P 500. So I have, in the past few years, I have looked back on my career as an activist short seller and, kind of done the math and felt like, well, I probably could have just been levered long the S&P 500, deferred my taxes, and gone through a lot less BS, and be in more or less the same position financially. So, I mean, that does make the market more fragile, but there's a Fed put, there's always a Fed put. Does there come a point in time when the system breaks and the Fed can't fix it? Theoretically, yes. In our lifetimes, I don't know. So I think for now, it probably just pays not.
Phil LeBeau can tell us a little bit more about this tentative with the IAM. Hey, Phil.
Hey, it's a far-reacher contract, Carl. That's for sure that the machinists will be voting on Wednesday. Here are the details of that contract. Remember, they rejected an offer last month for a 25% raise over 4 years. Well, that's not what they're being offered now. The tentative agreement calls for a 35% raise over the next 4 years. They've sweetened the ratification bonus by another grand, bumped it up to $7,000. They're also adding a one-time $5,000 deposit in every employee's 401k plan. And then there is the annual bonus, which originally was not there. Now it's in this offer. And not only is it in there, but it will be at least 4%. Question is whether or not they can get this over the finish line. The machinist leadership, which recommended the previous contract, which was roundly rejected by the rank and file, it is not recommending this deal. It's not telling the workers they shouldn't vote for it. they're sort of taking a step back and saying, here are the details. You make the decision. These are the hurdles that Boeing needs to clear here. You've got this contract. We'll find out on Wednesday when they vote. There's the capital raise, which is widely expected to kick in after the contract is ratified. If it's Wednesday, then it might happen this week. And then you've got them cutting costs and staffing. They've already said they're going to cut 10% of the company's workforce. They've got a lot of other things that they need to make decisions on, whether it's defense, space, what else happens within the commercial airplane business. Lots that will come out likely, or at least we'll get some indication of what they're thinking on Wednesday when the company reports its Q3 results. Yes, they already warned about what the expected loss is going to be, but we're going to get greater clarity regarding the financials, the liquidity of the company, and we'll hear from Kelly Ortberg for the first time. Analysts, they haven't heard from him. This will be his first analyst call on Wednesday, and we'll get a sense at that point where he sees the company.
Be sure, two things. One, the Spirit deal, and two, what is the SEC really saying that is holding this deal up, the equity deal?
Let's start first off with the Spirit deal. That's still the plan, to get the Spirit deal done. I wouldn't say back burner, but they clearly have more pressing issues in terms of getting this machinist contract done and then doing the equity raise, the capital raise. And then with regard to the SEC, look, Jim, they've already done the shelf registration, the universal shelf registration. It's just now a matter of, do we pull it off, and how much of this is going to be equity? In terms of, many believe it's going to be about $10 billion. Is there a convertible in there for another $5 billion? Do they do $15 billion? Or do they say, you know what, we're comfortable with $12 billion? I think they still haven't completely locked in on a final amount at this point.
Okay, so the way I look at it, this is my take, is that you get the earnings already pre-announced. Phil, the demand for this thing is insane. I mean, this thing's going from 148 to 160 with nothing good. Now that we have something good, I shouldn't say it with the union. I mean, to me, I'm trying to understand the demand. Why does everyone love this situation?
Well, in terms of the equity, look, we've talked about this. It's going to be dilutive in terms of how many more shares are going to be out there. But if you look at Boeing, separate from how many more shares will be coming into the market if they do the equity offering, if you look at Boeing, there's nowhere to go but up. It can't get much worse from here. And Kelly Ortberg has already said, we will restructure this business. There is the possibility, if they can execute, and that's a big if, but if they can execute over the next couple of years, boy, they can really start to get the cash flow going. Now, admittedly, they've got a lot of things that they need to take care of before you can say, yeah, we see that happening. But they believe that they can get the production rate on the MAX increased starting early next year, potentially. It's still capped at 38 per month. You start getting that going, you start doing a better job in terms of controlling your costs, and you're going to cut 10% of the staff. I mean, there's some real potential here.
Yeah, that's a hopeful note, given this line in the Journal this morning, Jim. Industry insiders are beginning to ponder something previously unthinkable, whether a breakup or bankruptcy is in Boeing's future.
I'm with Phil, not that story. There's excitement about this deal.
Carl, I know that note is out there. You got to go a long ways to think about them going towards bankruptcy. Now, look, if this vote comes out and they reject it again and this thing drags on for several more weeks, anything is possible. But given where this company is and given the moves that Kelly Ortberg has made, I don't know. I think that might be it's very premature at this point to talk about bankruptcy.
Yeah. A bit with your help, maybe. Phil LeBeau this morning, busy day. Let's get to Phil LeBeau.
Thousands of striking Boeing machinists are set to vote on a new contract proposal on Wednesday, which is the same day the company is going to report third quarter results. The Boeing workers walked off the job last month. The latest deal would see employee wages rise 35% over 4 years, and it also includes thousands of dollars for bonuses and 401k contributions. Joining us now on the corporate fallout from the strike, Eric Desenhall, Resources Chair, and you've watched a lot of these crises at different companies over the years. Eric, are we at a moment of clarity? A lot of times that comes from a different type of crisis, but when something hits bottom, there are some telltale signs. There's a new CEO. There's an acknowledgement that money's going to have to be raised through some new offerings and maybe some asset dispositions. Not hearing quite as much from the media. That's usually a good sign if the media loses interest in a story. So are all those things indicative of a bottom?
I think that what we're seeing is really a step in the right direction. I mean, when we talked a few minutes ago, one of the things we talked about is the need to sell assets and resolve the strike. These seem to be going in the right direction. These things are part of the cocktail. And generally, when the media lose interest in play-by-play, things are very good. I mean, look, the solution to crises are usually very boring. They are things like selling assets, raising money, government intervention, getting new contracts. They're the things that are not particularly sexy. And I think that these two pending situations seem to be very good steps in the right direction.
The company sort of stabilizing and reaching a bottom is different than whether the stock hits a bottom or is actually ready to recover. And after all, there are going to be more shares outstanding, so that's dilutive. I don't know how the public perception is going to change. I would think if wages go up, that margins could be adversely impacted. Although I don't know if labor is the biggest expense at Boeing at this point, but a stable company doesn't mean the stock's headed back to $250.
No, those are two very, very different things. I mean, I can tell you one thing, that public confidence is not encouraged by constant coverage and this kind of orgy of head rolling that seems to accompany modern crises, that the solution seems to be firing CEOs. I mean, at some point, you have to let somebody do their job, succeed or fail. And generally, I think when the public starts to become a bit bored, you have a chance to recover, as opposed for this expectation that someone's going to come along and pull a magic rabbit out of a hat.
So, and it's a constant concern for Boeing. They don't just make a product. They make something where, I mean, we need safety across the board. All U.S. companies, if you make drugs, automobiles, whatever it is. But few companies are at such a risk for a major event where, there's a huge loss of human life if there's a safety issue. And, you're still trying to have the most profitable company that you can safely have. So it's a constant fine line that Boeing has to walk.
Well, we always divide crises, at least when we teach MBA students, between the chronic and the catastrophic. The problem you have with the airline industry is the attention it gets tends to be triggered by something catastrophic. We memorialize in our brains catastrophic incidents or the potential of catastrophic incidents, whereas a drug company that makes a drug that occasionally has side effects that you anticipate, this is more episodic and chronic than it is catastrophic. But I think when you have an airplane, I think we all know what people fear, and that's what drove this into the news at the forefront at the beginning.
So it's going to be if the strike is settled, then we go back to what you're hoping for, or what you think the company is hoping for, and that's a boring. Maybe singles and doubles, get production levels up a little bit
and
more.
Don't have accidents.
No accidents, no more software issues for pilots, no more, doors popping off, or I guess they said it wasn't a door, but none of those issues are acceptable at this point. Can Ortberg accomplish that?
Well, I mean, I certainly think that by not allowing Ortberg to accomplish it. That's not good. So at some point, you have to let a CEO give it a shot. And any safety-related crises I've ever been involved with tend to be resolved by not having those bad things happen and not having attention being driven to the company. Safety-related incidents tend to be the catalyst for further examinations of culture, of how the company is structured, and I think that'll go a long way. The only question mark I have, and I can't answer it, is whether or not the resolution of the strike will be financially doable. But that's something people who know more about finance than I do will have to answer.
But also, there were the two catastrophic events with Boeing, but then it was just a drip, 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 drip. Some things didn't even result in any actual occurrences. It was just reported, oh no, we found another, structural weakness in the fuselage. It's, how do you stop that? And how does Ortberg? I can't imagine it'd have to be a whole new culture. You'd have to.
Yeah, but new cultures take time. I mean, it's not like a new CEO comes in and says, a bad culture, go away. I think it takes time, and so the lack of cinematic episodes, plus these boring sort of managerial operational steps. I mean, these are things that are part of the cocktail that get you closer to boring your way out of the news.
This Halloween, it's time to turn up the heat and bring those spooky vibes. The John Galt YouTube channel is hosting the ultimate sexy Halloween costume contest, and you could win over $300 in cash. That's right, first place takes home the biggest prize. But don't worry, second and third place will still score big. It's easy to enter. Dress to impress, flaunt your most creative, sexy, or daring costume, and show up to the live stream during the evening of October 31st, which is a Thursday. Come on over on Halloween and flaunt your very best and enter your chance to win the grand prize. Let your imagination run wild. You can be a witch, a vampire, a ghost, a nurse, a cheerleader, anything goes. The more unique and bold, the better. Winners will be crowned based on creativity, style, and those spooky Halloween vibes. The John Galt community will decide who takes home the glory. So what are you waiting for? Get your costumes ready now and come on over to win that prize on the John Galt YouTube channel. Hit that subscribe button, follow the contest rules, and you could be walking away with cash and bragging rights. This Halloween is not just about tricks and treats. It's about winning big on the YouTube channel, The Urban Landlord. It's the only place doing this. Let's have some fun, let's have some laughs, and let's have a spooky good old time. See you there.
What's up? What's up? What's up? What's up? Let's see. What's up? What's up? What's up? What's up? Okay, yeah, Campbell. All right, you heard the ad. Come on. We're at $655 out of the $1,500 pot for Halloween. So I have a lot of stuff to cover today. Got to do some futures. Got to talk about triple witching, things like that. More knowledge drop. Let's look at the charts, see what's going on. I don't think I saw too much. I had to sell a little bit of silver miners. Most of my gold holdings on the ETF. So that's done. That trade's almost finished. And we should cover some other metals. I'll talk about aluminum today, so we can start talking about other things other than gold and silver. Let me see. EXK. So EXK was my favorite silver miner. Nice high beta risky stock. So you guys can see that right there. Zoom in, take off the message. Oh yeah, you'll have about two. Wait a minute, we only got 1 week left, right? Yeah, 1 week left for the Halloween thing. Yeah, 1 week left. Man, I can't post that. Oh yeah, I already posted it. Okay. It went through. Sorry for spamming the chat. StreamYard is kind of getting all weird, huh? With the chatting, sometimes it doesn't post it in time, and I think it didn't go through. Yeah, sorry about that. Okay. Okay, EXK. I sold up here, so we're near the top of this range. So I'm gonna go to the daily chart. You see that? Yeah, this area is kind of in contention. It's been in contention for quite a bit, and we started going up on retail news. I believe it was because of retail news, and then it just pumped from there. Retail sales was very good, showing a lot of strength. So economy's doing well. So demand for silver should be up, and I think Chinese demand is for silver has also going to go up next year. So yes, silver will definitely be one of those industrial metals that'll do well. So silver is kind of like precious metals into industrial metals, and so yeah, and as well as a precious, yeah. So it covers all the bases. That's why silver's in between the gold and copper. And we both know copper and gold demand is going to go up next year. I believe China has the most silver reserves outside of major producer of silver, Peru. At this point, Peru is major producer of silver. So this is a small silver miner. It's pretty risky to play because it moves very fast compared to others. Like you can see here, it has 2 of these days that was like it just crashed. So this was 20% almost, 7.5% or something. And then I bought around this red zone here, set by this green bar. You can see this green bar is very important because it was during earnings. So that also makes it very significant how it moved here. That set the range. So when it dropped back here, you can see it stayed mostly within that range before taking off again. Now we're back up here. So I don't expect it to break out this week, but you never know. It might, because we have to worry about Newmont, because Newmont will have earnings. It's a big gold miner. So whatever they say might affect the silver miners too. Wednesday after the close. Yeah, this Wednesday. And so look at GDX. Yeah, so it's doing its nice pattern, but today it dropped from the high of open. So let me show you this one. Yeah, let me show you this one. GDX. Yeah, you see this? So I drew the 2 lines here in the range, and then if you go down, zoom down here, yeah, we kind of overstretched a little bit. So we've been kind of going on this nice uptrend on this daily chart. You see this nice uptrend, and this is the first time we've crossed here since I talked about this before. Yeah, during COVID, basically. September 20th, 2022, and August 2020. And then you see this red bar here, this significant red bar in April 2022. This really set that range here. And you see it's like when it creeps back up, it's like it's fighting. Like there's a lot of fights going back and forth, seesawing. So these are huge moves, Every time it retreats, it has to push back up, and it's like going up 5%. This is wild, very wild fight here, but it keeps pushing up, and now we've crossed it. So definitely, this is something we should pay attention to. What's up, San Jose? What's up? And so, same thing with Bitcoin. Same thing. We're moving up, itsy bitsy spider style. So let's see how it goes. Bitcoin, similar idea. So this is the gold, and you can see with silver, yeah, this is very important range. We've really crossed the threshold. So silver's finally breaking out of this area here. So I can show you this resistance, right? This thing I can show you like that. So this area that was set in 2021 we're finally breaking out. Very significant. All this is very significant. Okay. Let's go and look at Alcoa. So this is aluminum. This is pretty much the biggest aluminum company in the US, I believe, or at least the most popular stock to look at. I'm not sure if it is the biggest. But anyhow, this one I'm going to do a monthly chart, okay? So each candle is a month. And you can see it had a nice move since the 70s. Very nice stock, right? You go from about $3, yeah, almost 350, and then you go all the way up to 90 in the .com eras. So like 2000, November 1999, 2000, January 20, like yeah. And then we just went sideways, okay, all the way until the great financial crisis, and then plummet, crash all the way down. And then we're in this wild, like bizarre looking range. I don't know what you want to call this. It's just, yeah, this is such a schizophrenic looking thing, right? Now, let me put up on here CLF. CLF is a steel company, okay? So I use that as a proxy for all the steel companies. So let's just say this, it's like this. And you can see, like, yeah, it kind of mirrors aluminum, but not really, right? Not really, because you have yeah, it's not really a linear straight, like, compared to aluminum. Aluminum goes exponential here in 95, and then steel just like dies off, and then all of a sudden steel goes crazy and catches up, like tries to catch up with aluminum. It's just like, all right, and okay, and then it goes wild too, right? It has this schizophrenic moments. It's just like, okay, it crashes, but it recovers, and then it crashes even deeper, like from 20, I don't know what happened here, 2012, 2013. I don't know what news happened that made it do that, but okay. And now you got COVID. Now it's mirroring it. So it's mostly matching it now. Mostly matching it, right? Okay. So the question is, if we are in a commodities boom, so if gold is up and gold is a leading indicator of inflation. Let's put it that way, because I showed you that other chart. Yeah, let me show it to you again. Gold leads oil. Okay, gold leads oil. So I'll put this up. Gold leads oil. Where is it? Where is it? Oh man. Nope. Not that one. Not that one. Okay, must be this one. Okay. Make sure you guys understand what I'm saying. So gold leads oil by about 20 months. All right. Let me go. Go. So you see how well this is? This is the gold shifted, and oil follows it pretty well. Now, I don't know like how it predicts all this stuff. I don't know if gold actually predicted COVID-19 or whatever, but hey, it follows it pretty well. It's not exact, but it does follow the trends. And we're going to be in an uptrend, and this is the first leg. The first leg will go up at least until January. So, and then pause, and then we'll go up again. Okay, so the next big leg will be starting in summer of next year. So that's where oil will be popping. And so if gold leads and shows us where inflation will be, because it's essentially saying that oil is going to follow it, and oil drives a lot of the inflation you see everywhere around the world. And you already know we see copper getting expensive, because copper is still close to $5 a pound. And with China pumping back up, we're going to see more of that. And I believe I talked about copper in China maybe several streams ago. So you can go look at that back and see what I said about that. So what I'm going to say is prepare yourselves. Prepare yourselves for a lot of commodities to rise. And let me put in copper here. So now this chart's going to look more confusing, but I'm going to take away the steel. So you see copper kind of has that echoing effect. It pushes up and then it goes and goes, and now it's pushing up. It's doing a lot better than steel. So I would say, I'm going to be watching these things. I got to be watching these things all together, because if the industrial metals matches all the other metals, we have to get ready. Yeah, I think we have to get ready. Now, is it a good time to buy AA? That's the ticker symbol for Alcoa. I'm not sure. Not sure. I do know that Japan wants to buy U.S. steel. So we're still in a situation where we're not completing the deal yet. I think here this is when all the news started happening about December 2023, and it went up all the way to the price it was offered at, $48. But yeah, there's unions there, and regulators don't know if they want to complete this deal, but it's still, we're still at this area here. I think, U.S. Steel hasn't performed as well as CLF. Yeah, I think. No, actually, no, not about the same. Yeah, I still don't get what this huge drop here was. It must be a company. Yeah, it must be a more company specific issue of why. Yeah, this is the ETF for steel, SLX. Yeah. Still, there was a huge drop into 2015, end of 2015. Yeah. Okay, I don't know. I don't know why. But yeah, look at that. Look at that. It's tightening. This whole area is tightening up. So that might be an indicator of something's about to pop off. Let me see. Yeah. Yeah, the range is coiling up. When you see something like that, I don't know. It's about to make a major move somehow. The traders are kind of done trading. That's interesting. Okay. I think apart from that, we can continue on. This Wednesday, we will have a big earnings. I believe it's Wednesday, right? Yeah, it'll be Wednesday, I think. Tesla. So let's see what people say about Tesla. Are we going to bet against Tesla or not? Because that will really determine the NASDAQ.
Has this perfect balance between BSing and delivering. Okay. I mean, the cars drive, the rockets fly, the satellites work. He does these incredible things. Does he routinely overpromise? I mean, say things that it's hard to imagine he can say with a straight face? Yes, he does. But does that matter? Apparently not. So yeah, nobody's played the game better than he has. It is a volatile stock, but it continues to get flows. Going back to what I said earlier, and will continue to get flows. And I think what everybody on the bear side missed about it, the arguments were, oh, Tesla doesn't have the scale, it can't compete with Toyota, Volkswagen, blah blah blah, and that's true. They didn't have the sales base scale or the manufacturing scale. But what all of the bears missed, and was what my epiphany really was in 21, was that Elon understood that the base the scale he needed to have was capital base. And so when he was able to yoke that stock price way up and have this enormous market cap, I mean, even if the company's bleeding billions of dollars and the stock is sinking, there's so much market cap that he can continue to raise money, and Tesla's not going bankrupt in for a very long time. And that's what the bears missed, because the bears were hung up on this, oh, it bleeds money, it's going to go bankrupt.
Right.
And look, I was in that camp for a number of years, but no, Elon pulls rabbits out of the hat constantly. Look, it's one thing to bet on him or bet on Tesla, but I just won't bet against Elon. I did in a minor way several years ago. We had long dated crash puts on Tesla that almost hit and paid off, but no, it's just, you can't bet against the guy.
Yeah, you can't bet against Elon, huh? Yeah, you can't. So that's what he's saying there. The stock is so expensive, so much capital has been built up in that stock that, yeah, he can use that as funding, right? The stock itself is the cash machine that like perpetuates his company, despite any hiccups he might have. So yes, and that's the reason you buy stock. You're supporting those companies, right? Anyway, let's look at the earnings. I mean, the stock price right now, because we're still recovering, trying to recover from that whole robo-taxi event with those robot servers that apparently weren't AI because they were remotely controlled. But right now, we haven't done much since it rallied in June 2024 this year. And we're still in this range that was set back in December 2023. So we're still stuck. We're still stuck here. We've hit this area a couple times, July and then September. Yeah, so now we're back down in the mid-range between those areas. And, you have this ultra low at 142, and we're about 261 is the high. And then you got the upper bound at 292 set probably in September 2022. You see these areas here that are highlighted. See, they make a lot of ranges here. So you can look at them as little structures. Little accumulation, distribution, more distribution, blah, blah, blah. And then we go up. So what is this? What is this now? And this is a hard thing to guess until we get that earnings. And then once we get earnings, we're going to get the elections. So this is a big deal, very big deal, especially with Elon doing everything for Trump. So he's picked a favorite, And so I think that's a good segue for the election stuff. I'm going to talk a bit about the election stuff. But before I do, let's do a quick overview of where we're at on the QQQ and the S&P. Okay. So let me use this chart. I'll remove this and this. Yeah, let me use this chart instead. Yeah, nothing much changed here. We're at about 495 on the QQQ. So nothing much changed. Oh yeah, I wanted to talk about also about Mondays after option expiration. So we had monthly option expiration on Friday, and you have a Monday effect, So that's what they call a Monday effect. So that's why you saw today, like it just all of a sudden just started like tanking for, I don't think there was any news. It's just positions unwinding, and you see it came back up, and like the S&P is back at 583.67, and you look at the Nasdaq, same thing. It just suddenly crashed. It's just clearing out everything. Okay, we're just cleared out all the options, so there's nothing going on. There was no any major reports. I believe Nucor reported, so that's a steel stock today. So Nucor, NEU, Nucor. Yeah, Nucor. Let me see what's a Nucor. NEU. I mean NUE. NUE is the ticker. Nucor. It's down about 2%. So nothing major. We'll see what all the other steel guys do. But tomorrow morning we'll have a lot of little guys that we want to pay attention to, like GE. You got 3M, GM, RTX, Raytheon, basically, and Lockheed Martin. So that's what will be in the morning. But that's about it. We'll see what's up. And let me see how's the Hong Kong market doing tonight. Man, it's still trying to goof around. So I still have my Yang positions. I haven't sold them. I added on last Monday. So this is Yang. So if you want to short at China, this is Yang. Yeah, let me see the daily. Yeah, see, I bought here. I started buying here when it hit 250. Then I bought again. I think here. Oh, here Monday, about close to $3, 3.15 somewhere here. And then it went up to 4, pulled back to 3 something. Now it's back. So I don't know. I'm still holding it, but yeah, and it's gonna and the other reason to hold it too is because we already got the GDP numbers, and then so any good news that came off of that is already done. Now you got earnings to go through with China, and there's not many Chinese earnings until you get to the Alibaba one, and Alibaba will be way after elections and all that. And once you know the elections, it's like if Trump wins, it's easy. Like if I just keep holding it and Trump wins, Alibaba can easily just wipe out this whole move. Like, so when it went from like 80 to 100 something, yeah, all that shit could just come crashing back right there. We're going back to where we started. And that's when you buy the Chinese stocks, I guess. It's again, because once Trump wins, let's hear what he says about tariffs. Let's see what he says about China a couple times, and then you just buy in on the weakness, and then wait for the earnings. And I believe, let's see, earnings will be Thursday, November 14th. Okay, so that's a while. That's definitely a while. We got a month. Got about a month, so we can see what that. JD is another one to look at. So its earnings is 15th, Friday the 15th. Okay, good. Good. How is Temu? Temu is owned by Pinduoduo. This one. It had a pretty nasty earnings on August, but it was probably one of the only Chinese stocks to do well since 2022. But yeah, the most of that move is already done. If it's going to continue up, it's all dependent on what's going to happen after. So it's going to follow the rest. So you missed out on most of this stuff here. So you could have bought it at like $40. It went up to 160. That was the move. Xiaomi, another good one. Xiaomi Corporation. That's where they make the cell phones and the cars. Yeah, you could have bought it at $1. It would have been at $3. See, it's still going up. Xiaomi is the better Chinese stock. Yep, I talked about those. Xiaomi is XIACF. That's one of the ticker symbols. The other one is XIACY. So the only difference is that one of them is just less voting rights or some. I don't even know if you can vote with ADRs for some of these ADRs. Yeah, so I don't know if you're allowed to vote or like nobody cares. Like one of them is just cheaper version than the other. That's it. That's it. But I use the F1 because that's where most of the volume is. The more expensive one or cheaper. Is this the cheaper one? Yeah, or whatever. I don't know. I keep forgetting which one's the more expensive. Why? I'm looking at the cheaper one. My bad. So this is the more expensive one, the XIACY. So I look at that one because it has more volume. And what was I talking about? So Alibaba is BABA. Okay, JD.com. And then I was talking about PDD, which owns Temu. PDD is Pinduoduo. Okay. Then what is that? BYD. That's the other one I look at. BYD. Why, I guess. Okay, is this the more expensive one? Yeah. So yeah, this one I'm watching the most because it's the most similar to Tesla in a way, because it hasn't really done anything since the 2021. It's stuck in this range. You can see here's we have to wait for Chinese demand to pick up, because if the domestic market is weak, you're not going to get anything. And that's why Tesla's stuck too, because most of this you see here, it's been stuck in a range since 2020, 2021, because, it also needs the Chinese market to grow, because the US market is done. There's no more growth in the US market. You can't force everyone to buy a damn Tesla, right? Or an EV. So that's why you see things are winding down in the US for EV demand. It's really, you have to put more government incentives to make people, or government regulations that force people to buy EVs now. I guess that's the only other way. Otherwise, just China, because China is the only one really pushing it for most of its people, because that makes a lot of sense in China. You have a lot of internal combustion engines in China, plus their coal plants. It's creates a lot of smog. I mean, when I went to Beijing in 2010, I was very fortunate. 2008, I guess. Yeah, 2008. I was very fortunate. That was during the Olympics, I believe, the Beijing Olympics, and they had to clean everything up. So all the pollution had to be stopped, because otherwise people coming over there would be like, it's smog all the time, and that's why they wear those masks. So yeah, and India has a big smog problem, right? You go to India, it's completely smogged up. So yeah, it's crazy. It's crazy when those high population countries don't control their cars emissions, because it becomes unlivable. So that's why it's just a population thing. Yeah, what's up, J-Ro? So anyway, now let me go back. I forgot what I was going to talk about. Again. Let's go back here. QQQ. I said that. And the other thing is LRCX. Yes. So this stock got hit with the ASML earnings last week. So everyone's eyes on that. If you want the NASDAQ to lead, and what's the other one? TXN, Texas Instruments. So Texas Instruments will be tomorrow after the close. LRCX, Lam Research, will be Wednesday after the close. So both these stocks important for the SOXX. Semiconductors completely faded all their gains from the small bump in TSMC earnings. I believe it was Thursday morning, early morning. So yeah, people made the quick trade. They sold. Once it's over, options expiration, we're done. That's it. Nothing. We're back at the beginning of where we started, right? So we're still at the bottom of this rectangle. Went to the top of this rectangle, spent from October 1st all the way to October 14th, crashed on those leaked earnings. Now we're back at the range. So this is do or die. Because if this thing fails to break and we start rolling over, that's it. We're going back here. We're going back to 210s again. And that means the NASDAQ will follow it, like most likely. We have all the big tech earnings: Google, Amazon, Apple, all around Halloween. Who else? Meta, right? Facebook, basically. And yeah, so we got those four. Did I miss someone? Microsoft? Yeah, I said Microsoft. Yes, probably some other one. I forgot. But that's really what's going to stop it from breaking out here to 505. So if Tesla moves up, and those two stocks, Texas Instruments TXN and Lam Research LRCX, takes the QQQ to 503, then that's in a good position to short, right? So if you're gambling and you think it's time to short big tech, yeah, before earnings, that whole week next week, yeah, I was short it there. But that's you're a gambler. That's on you, man. I'm not going to do that. I'm not going to do that. Does Nestle have a stock? Yes, Nestle has a stock. I'm pretty sure Nestle has a stock. It owns water. So if you're into water, I was talking about water before. So PHO is the water ETF, CW, consolidated water. What the heck, or is it consolidated? Yeah, CWCO. Yeah, this stock here. Yeah, it could be a good stock to buy if you're into water. So Nestle has a stock. Let me see. If it's not listed here, it's listed in France because it's French. Anyway, blah blah Nestle or Swiss. Looks like it's Swiss. Well, whatever, same difference. So yeah, I don't know if they have a U.S. one, but yeah, they definitely. Well, they got German listing too. So yeah, it's European. I know it has a stock, but I don't know if you can get it in the U.S. You got Nestle India. Let me see. Maybe it's in the OTC market. Yeah, it has an ADR. Yep. Okay, it's got a weird ticker. Here it is. So you can buy this NSRGY, Nestle. Yeah, it hasn't been doing well since 2022, but you know, it's European, so it's kind of one of those European stocks have European issues. And also, you know, if the dollar is stronger or dollar is weaker, it'll affect your it'll affect the price of the stock when it's priced in US dollars. So that also you have to worry about. That's why when you buy international stocks, most people have a hedge on currency hedge or do complicated things, but you know, that's not really worth it for someone that doesn't buy that much stock. But if you buy a shit ton of Nestle or Lucent, Nokia, something like that, yeah, you have to think about those things. So that's what the rich people have to worry about when they buy international stocks like that. I think that ties into Jay Rill's question about taxes. See, so but this one you don't have to worry about. I mean, you buy it here, like yeah, you don't have to worry about like paying international taxes, but you're gonna have to worry about currency exchange rates. Yeah, if the dollar gets stronger, your Nestle stock's gonna get weaker, right? The dollar gets stronger versus the euro, then yeah. So just because of that, so the stock could just go down just because of the currency, nothing to do with the stock itself. Anyhow, okay. I don't know. Is it it's really worth getting at this point? It is almost at the 2020 low, but I'm not sure if it's because of news or other factors. I see a lot of volume down here, so something's up. Yeah, maybe I'll have to look at this further independently. Okay, so I talked about the coming up earnings. So we got the S&P still near the high. So see, nothing's going on. So I can't say I'm bearish. I can't say it. The only way you're gonna be bearish if all those earnings, Apple, Amazon, Google, next week, yeah, all next week. You got Intel too. Intel's next week, all on. Yep, all Halloween, all by Halloween. Yep. And when we were talking about the videos earlier on, we were talking about Boeing. Yeah, it will have it on Wednesday. Okay, we will have earnings on Wednesday for Boeing. So the strike completed. They got some kind of deal going, so it popped a bit. But that doesn't mean it can just go back down. But as it is, sometimes, you know, if it has bad news and everybody already expected that bad news, it can just go up, still go up. So it's fine. But that's up to you to gamble before an earnings. Usually I wait for the reaction. So we don't know how bad the news is. If it's really, really bad, then yeah, it'll go back down. But if it's like bad, but it's bad in a way that's expected, then it'll just go up because there's no new bad news. So if the bad news is already out, everybody knows it's bad news, and you go into earnings and it's already there, then the stock will pop. Lots of times I see that, like Snapchat or some trash company that Like, oh, hey, we already knew there was bad news, and it explodes. It jumps up like 30%, like here in April. It's like, yeah, it's bad news, but we already know it's bad because the stock already crashed the earnings before. Like, you see this? This is some bipolar freakish shit. Like, you're just going up and down like this every time there's earnings. Snapchat is an amazing stock. It's just a gambler's paradise for earnings. This is Snapchat. Yeah, Palo Alto Networks. Yeah, Palo Alto Networks. Eh, eh, I don't know. I don't know about this stock. Yeah, I don't know. I think maybe it's already gone as far as it could. I used to work near their headquarters. I don't know. So yeah. Was it their headquarters? I don't know. It was a big office. Like, they rented out a whole office building. I think it was headquarters. Let's see. Had this huge. Yeah. So now it's back at the top again. I don't know. Guess we'll see. I like ANET. ANET's one of my favorites. It's like a little baby Cisco, but it's better at doing what it does. So it's like $50 here, and it goes up to 400. I like this one. This one was nice. It sucked like in 2018s to COVID times. That's when I wasn't playing it. But once we got COVID, it was like, oh, it's back to good. Because I used to play it ANET 2016 up to 2018. Then it just started sucking. Then I got out. Because it's just doing this range thing. You see that? It's not growing anywhere. Yeah, because I think at this time it was having a hard time finding new customers. So you see that, and then once you got hit COVID, it's like, oh, free money printing, and now it's growing easily again. So yeah, we'll see. You see, it didn't do it. It's one of those nice stocks because when the stock market was like going down, like here, I'll show you the QQQ. Yeah, you see, when the Nasdaq was going, and the whole market anyway was going down in 2021, 2022, like the end of 2021 started crashing 2022, it was still going sideways. So that's one way you could tell like there's something going on, right? You see that? Like it's going down here, but like not much compared to the rest of the market. That's how you knew it was gonna really pop up real good. That's one of the things. So notice the strength. Notice the relative strength. So if I went and gave a ratio of ANET over QQQ, you see, you knew not to sell it. So you would have been like, nah, I ain't selling that shit because it's going down less than the Nasdaq. So if I'm a long-term investor, I'm not selling that crap. Probably I would be adding because I know that based on this ratio, it's still outperforming. So it's going down less than the Nasdaq, or it's going sideways compared to the Nasdaq. So that's when I know the future looks good because people were not selling as strongly as they were buying. More people were still buying that stock. So that's how you know. That's why I say you look at these ratios, you'll know, right? You can look at any ratio. So let's look at Palo Alto Networks then. Look at Palo Alto Networks compared to the QQQ. How does it perform, right? Compared to that. See, this one's not as clear. It's like it kind of performs okay, decently more than the Nasdaq, but not really outperforming it like really, right? You see this? Compare it. You can just compare it. Like compare with ANET. See that's more of a this is more of a straight line going up, right? So the slope is still good, but then if you look at Palo Alto Networks, it's like so because you got to look at where your money is, okay? It's just like you got to look at where your money is. You can't just put your money everywhere. You just can't pick every stock. I mean, when you look at a stock individually, you're like, okay, yeah, this looks good. Palo Alto Networks looks fine, but like, well, I could just buy the Nasdaq and it looks fine too, right? What's the difference, really? I mean, yeah, okay, maybe this went down more than Palo Alto Networks, but still, like, I could just bought Microsoft or some shit and like that. Or Apple. No, Apple's not that good example. What's one that's really good? Yeah, Nvidia is okay. Nvidia is obvious. Duh. Nvidia, yeah, of course. But I'm just saying, right? You know, like we have to be prudent about what stocks we pick, because we're not billionaires here. I can't put my chips everywhere. Yeah, I can't put my chips everywhere. You know, we're small fish. We gotta use our powder wisely. You gotta use your gunpowder wisely. I'm not gonna shoot at everything, right? Okay, so even if that's the question about does it have room to grow? I don't know. Remains to be seen. But as you can see, like ANET, somebody believed that it had room to grow because it did something differently in 2022 compared to the others. It kind of just tried to stay going sideways. So somebody here knew there was room to grow, and look at it, boom. Once the stock market finally stopped like crashing, it's just like, okay, continue on. We're moving back up again. So somebody knew there. Somebody did. So that's all I'm saying. All I'm saying. Yeah, Antoine, Snapchat is like, yeah. I mean, like the only time I heard people talk about Snapchat was like when Dan was up here and talk about like, oh man, or was it lasagna? No, it was Dan. I think it was Dan. Talk about like Snapchat. I mean, I'm not a Zoomer. I don't know. Fucking people still send nude pictures on that crap. Like, look at this thing. Like 2021, it was like $82 and it just crashed all the way. Oh shit. And after that, it just became like a gambling stock because people just wait until earnings and go like, bet it's gonna go up, and then bet it's gonna go down, bet it's gonna go. Like if it just stays in this range, all right, yeah, sure. I could say it's stable offshore. Stable offshore. What's that? I don't know what that is. Man, I don't know what that is. Stable offshore. Yeah, I haven't heard of this company. What does it do? Oh, energy solutions. Okay. Okay. Let me see. Let me research this. Oh, okay. Interesting. Nice. I was gonna talk about some interesting plays to make. Okay, I'll make a note of this one then. All right, let me go here. No, I'll make a note to look at that. This one. Okay, that's good. Yeah, because I was gonna talk about what is it? The quantum computing stocks, because it made a crazy move today. So you got this quantum computing qubit stock. It was up 23% on no news. It's like, oh, all right. Well, when I see something like that, I'm paying attention to you now because you're so the quantum computing stock started rising when IONQ, this one started blowing up in this September So then the past couple weeks, I see this one pop in, and this one's lagging. This Qubits one, nah, this one's not still stuck. But you see, they're all penny stocks. It's like $1. It was like 50 cents, and you know, it's like, oh god, like what's going on here? I don't know. Someone try to short squeeze or what? But these are the kind of stocks you really want to pay attention to when the small caps start rising. So we'll get back to this later. Let me play. What's on my schedule? What's on the plate today? What's on the plate? So don't bet against Elon. Yeah. Now we're gonna play another one. Hedge funds. And you'll have to be reminded to do the options thing. I'm gonna talk about the options thing. Yeah, and I'll have to go through that. All right. Keep that in mind.
Just outline for us what you found in this reporting and why it is significant. Yeah, good morning. So if we start with the second point first, the significance. I suppose what's interesting here is that it comes after 2 years of the Inflation Reduction Act, which is, essentially a piece of legislation that provides tax incentives to do green investments. And it also comes despite enormous legislative and regulatory framework supporting green transition in the EU. And despite all of this, hedge funds as a group, they're not looking to ideology, they're just looking into how to make money, and they're largely betting against key green sectors. So as you mentioned specifically, more hedge funds are short solar than are long. The same applies to batteries, the same applies to hydrogen, the same applies to electric vehicles. At the same time, there are more hedge funds that are long oil, gas, and even coal, which, as you know, is the dirtiest of all fossil fuels. So despite historic stimulus packages, there's just limited appetite to invest in the green transition.
Yeah, because some of those prospects, I mean, you could make the argument as an investor, you follow the policy, follow the stimulus, and if you were to do that on these fronts, it would lead you to investing in the transition. But that's not happening. Why is that not proving a catalyst?
So it's a sector that's very sensitive to interest rate changes. And we saw, when there were emergency interest rate cuts during the pandemic, and there was very little demand for energy, the green sector did well. When the pandemic ended, lockdowns were rolled back, and the economy came roaring back. Interest rates rose, and there was suddenly a lot of demand for energy, with fossil fuels sort of filling a lot of the, the intermittency that a lot of renewables suffer from. And so in that environment, they've just done badly. There was an expectation early at the beginning of this year that with interest rates coming down, that would change. There would be a rebound of the green sector, but that hasn't happened. And the reason we kept hearing from the hedge fund managers we spoke to was geopolitics, and specifically tariff wars. They just don't like tariff wars. They don't like the sort of the uncertainty around this. They don't know how to trade it. That is the US and Europe as well imposing tariffs on China that are very detrimental to the solar sector. And then China obviously also retaliating. And the outcome of the US election is obviously also going to be key in determining how that tariff war plays out. So we had hedge fund managers talking to us about, if you see China in a sector of the green economy, run for the hills. And what we're left with is a situation where, climate change is a global issue, but it's bumping up against nationalism and protectionism even in the form of tariffs, which are basically just leaving a key investor sector sort of put off.
So that goes well with the Sable offshore you're looking at. So yes. Anything with oil, and all those nasty fossil fuels, natural gas, it's all going to be potentially very good. So we shall see. I think oil will come roaring back next summer, starting really to do it. And we'll see if Trump wins or not. That will also give another boost to it. But even if Trump doesn't win, I don't think you can fight the trends. Oil is still a big component of energy. So the only way you do green stuff will be uranium. So that's why uranium is such a hot play right now. And maybe continuing into next year, it'll be a really hot play. All right, what's up, Gary? What's up? Let's see. Let's go to another. I don't know. I want to play another video or go to articles now, because I wanted to see. Oh, this will be nice, actually. Yeah, you guys should see this one. This is interesting.
The European Central Bank just cut rates by another quarter point for its third reduction this year. The move had been fully priced by markets after policymakers flagged reduced inflation risks and a weakening growth outlook. It's the first time the ECB has reduced rates at consecutive meetings since December 2011. The ECB did note risks in its outlook, forecasting that inflation would rise in the coming months before declining to target in the course of the next year. Its key factor in reducing rates has been the Eurozone growth outlook. The ECB trimmed its Eurozone growth forecast for 2024 last month on the back of weaker domestic demand, lowering its GDP projections to 0.8%. Some of its biggest economies continue to face major challenges, including manufacturing weakness in Germany and a huge fiscal consolidation project looming in France, while sentiment indicators also remain weak. The Eurozone's weak economic growth and sluggish consumer price rises have raised concerns that the ECB may be facing the threat of too little rather than too much inflation. Economists have warned that the prospect of a continuation of reduced price rises is a sharp turnaround from recent historic levels of high inflation. This latest cut may usher in a series of faster and steeper reductions in borrowing costs in an effort to stop inflation from persistently undershooting its target.
So you see they're worried about like having an issue of deflation almost. Like if their inflation doesn't stay at 2%, they don't like that. So they're worried about maybe inflation's going down too much. And this is where things get really interesting with the steep curve of how you try to avoid a recession, because when you tighten monetary policy, yes, that usually leads to a recession. This is the first time anybody would see a soft landing. If Jerome Powell actually manufactures a soft landing for the US, that's going to be a first one. That's really going to be a hard thing to prove will happen. So that's why you have a lot of people like Ryan. Like every time Ryan comes here, he's talking about the curve reinverting. I mean, de-inverting. What they call it? Oh. Yeah, so you got the inverted yield curve, right? And it disinverts. Okay, I guess they call it disinverts. And the Psalm rule that Blacks talks about, I brought up that multiple times during the John stream. I don't think I talked about it during these streams here. I might bring it up again. But yeah, Psalm's rule essentially saying 3-month average of unemployment, if it goes up by 0.3%, something like that, that means that usually a recession happens. So all those little triggers have happened already. Actually, I can show you the Psalm rule here in my chart. But I don't subscribe to any viewpoints. I just look at charts. Give me the chart. Give me a chart. Prove it. Prove these things. Because if the stock market, you can find certain things to show you or any data. So let me see. What was it called? Prove it, prove it, prove it, prove it. Recession indicator. Was that it? Let me see. Was this it? I made this chart a long time ago. Come on. Was this it? No, this was something else. I showed you guys this before. But yeah, it doesn't look like there's a recession on this indicator. Never mind. Yeah, I showed you this like maybe 2 weeks ago or something. You guys can go back to that one. But no, I made one for the Psalm rule. They had a Psalm rule indicator here somewhere. Oh, here it is, Psalm. Okay. All right. And I did all this stuff. I put unemployment here or something. And I put, okay, let me put the unemployment. Okay. I put the S&P 500. Yeah, you see? It's hitting yellow. So once it hits yellow, it should flash red in a bit. But it's been going on and off, so can't tell yet. But once you go red, like here, during the 2008 crisis, you see? The Psalm rule already hit red before the last big drop in September 2008. So yeah, that's another indicator that would have told you something bad was happening. like before all the banks went gold, like Lehman Brothers and all that. I mean, the stock market was already kind of like hiccuping, see, in 2007, but the real shit, yeah, the real stuff already happened. So the Psalm rule already turned on around February 2008. Yeah, see. But we have times when the Psalm rule hit yellow and didn't do anything, So It's not perfect. It's not perfect. Yeah, you got times when okay, here you go, like 91, but the stock market didn't really crash here. See, you had a little mini recession here. Sometimes it can tell you something, sometimes it doesn't. So yeah, that's a nice little indicator. So you can look it up. The Fed. They call it the Fred, FRED. You can look it up, the Fred. So it's the Federal Reserve's little database. So you can grab data there. You can download it into spreadsheets, and So here, let me give you the link. Give you the link. So any kind of data you can import yourself. Okay, I put that up. So yes. So Zhang Wei said, "Do you listen to any financial podcasts? I like Peruvian Bull, Tom Luongo. I don't usually listen to any podcasts. I just look at charts, and I'll listen to people that have new perspectives on charts, but I try to avoid like listening to people's theories. I don't want to get sucked into a narrative. Like everyone has their own narrative, their own thesis. Like I know the dollar milkshake theory is from I forgot his first name, but his last name's Johnson. And so that was from that Ever Palisades podcast, like those gold bugs. There's so many people with like lots of agendas. And there's their Lead Lag podcast. Let me see. Yeah, who runs that thing? Lead Lag. It's the guy that came up with the gold to lumber ratio, or lumber to gold ratio. Yeah, lumber to gold ratio. Who made that one? Yeah, Michael Gade. Gayed. So I think he runs that Lead Lag podcast. Yeah, Lead Lag Report, called Lead Lag Report. But yeah, I don't try not to listen to too many of these guys. They all have their own thing. And you could get easily seduced. You want to have no bias. SEC disclosure. No, I don't do any fundamental analysis, man. I just look at a chart. So the whole thing is like, the whole concept is that if it's known in public, you don't have an edge. So anything that's known in SEC filings or whatever, everybody knows. So then it should be reflected in the charts. What isn't known is what's the insiders thinking. And that's why, you try to use charts to try to say, okay, I see what you're doing, insider. I want to get in what you know something I don't. It's not in the public. So I could tell just by looking at that chart something up. So that's why I want to show you that ANET chart, right? Something's up, and you look at the ratio between ANET and the whole NASDAQ, you saw like it's still outperforming. You knew some insiders knew already. They knew that it was a growing company and it would bounce back better than some other companies. So that's why you can really tell from a lot of indicators on a chart, and looking at just bars, just looking at straight candlesticks, you'll see like something. There's something going on, and that's the whole game. Because and if you want to do SEC filings and stuff like that, look at Martin Shkreli's channel. Like if you have major autism and you can read thousands of boring financial statements, yes, he's your guy. And he likes pharmaceutical companies, so he also has the edge of understanding the drug making world, so he'll analyze it from that perspective too. So I'll show you Michael Shkreli's. So if you're just a guy that just loves spreadsheets and stuff all day, yes, that's the dude to do. I don't make money that way. I just look at charts. So I try to look at thousands of charts, like, and you can do it automatically, right? Charts, and something that you can't do with, like, unless you see, you can just analyze whole debt structures from it. But at that point, it's better off you buy a Bloomberg terminal, and you got to pay, like, it's cheaper now, but you still got to pay like $1,000 a month about just to get a Bloomberg terminal, and then you can look at the bond market, because that's the way you get like good information. You look at the company's debt structure. You look at how they compose their debt to equity, all this stuff. So you see, like, oh, okay, look at how much their debt was being auctioned up for, how much demand was in that bond auction they did. So if Apple does an auction on 10-year bonds, and Qualcomm does another one, and you can look at that, and you can see how many people wanted to buy this bond versus that bond, and then analyze from because the bond market, the people who do the bond market are way smarter than the people who do the stock market. So because when they are taking their asses, taking a risk, and they don't want to lose their ass on giving you a bond, like, I'm buying that bond, giving you money for your company, and I want that steady return. Like, if you give me 10% return on some risky duration bond here for a crap company, then that means something. That means that person has analyzed that company's structure so well that they're willing to say, okay, you're a young company, you're growing, I'm gonna take a chance on you, and I'll buy that bond. So they have to painstakingly make sure it's all right, because the bond market is not liquid. I can't just sell and buy a stock, like a bond, just like a stock on the stock market. Okay, so if I made a mistake and I want to get rid of that bond, I might get screwed, because nobody wants to buy it from me now, because they know that, hey, you're a retard. You bought that bond from that company. You didn't do your homework. You screwed up. And now you go to the open market and try to get rid of those bonds. Nobody wants to buy them. You're too bad for you, man. Too bad for you. So that's why the bond market is always way smarter, and that's why you get a Bloomberg terminal. So SEC stuff, nah, man, that's public. Everybody knows that. So you don't get an edge. You want to have something where you are ahead of the game and try to get those bottoms, tops, or whatever, and that's what this show's about. That's what we try to do. And yes, and I don't think you can get that from fundamentals. The only other way is to do quant analysis, but quant analysis requires you to get data, and getting data is not cheap nor free. And even if you get it, you gotta really. And the other way is to use options, where you look at the options market. So I don't play the options market, but I think, like, yeah, you should try to read it. So we can discuss a little bit about that as the show progresses. And I think I was going to cover something like that today if we've got time. So yeah, anyway. So yeah, the lead lag, Michael Gade, lead lag report. Here's the YouTube channel for lead lag report if you cared. And there's the Palisade. The Palisade with those gold, silver guys or whatever. Yeah, there's a lot of people like that. But here. So yeah, this is the lead lag report. But don't get enamored by some of these people. So let's look at, like, you can look at lumber versus gold or something like that, and you can look at the ratio and look at it, it's down, right? So I mean, according to this thing, the stock market should be crashing, right? It hasn't crashed. So that's why I said, like, you can't trust some of these macro guys and rely on their information too much. All right, let's continue on. Go to the next video. Let's see what we got here. Okay, this is going into what the articles we were going to talk about. ETFs.
Of the bid for duration, and you think about the active debate that the market is having right now about the Fed's rate cutting trajectory, does that bid into duration make sense at this juncture?
So there's a lot embedded in the question that you just asked me, so I think I'd like to unpack it and parse it. So I think the first thing is active versus passive. If you look over the last decade, the growth of active ETFs has been double that of passive ETFs. So I think the market has spoken loudly, and active is the way to go in fixed income. Why is that? You get the benefits of active management, so research, security selection, and portfolio construction. Then you also have the benefits of the ETF, so that daily liquidity, the intraday liquidity, and the pricing, and the transparency, being able to see what everybody owns on a daily basis. So we are big supporters of active ETFs. On the topic of duration, which is a completely separate topic, I think it's important to remember two things. Number one, we have a record high in the amount of money in money market funds. So broadly, the American consumer is massively underweight duration and has a lot of CDs, money markets, et cetera. So the move into duration makes a lot of sense because I think people are underweight duration. Now, what is that predicated on? You know, our view is that the U.S. economy is in a soft landing. So soft landing, the Fed has cut rates 50 basis points. And yes, there's an awful lot of debate about whether they're going to go in November, in December, next year, how many times. But I think broadly, the Fed has telegraphed that rates go lower from here. And that is a great backdrop for adding duration.
So you mentioned a couple of things. I want to pick up on one of them, which is active versus passive. 4 or 5 years ago, there was a lot of concern that active ETFs would give away the secret sauce of portfolio construction. There would be all these bandwagon investors jumping on, getting a free ride by mimicking the holdings. Has any of that come to pass?
I hate to say it, but good luck with that. The ETF that I run, 2,973 line items. If anyone here thinks that they can replicate that without the benefit of a global research platform, risk management, and everything else, they can have it. Yes, we publish daily what we own in our ETFs.
And you show it out there and no one's getting a free ride?
Yeah.
Let's talk about how active you need to be in, for example, the government bond space versus the corporate credit space, because much has been made about how tight corporate spreads are. Both of you look at high yield, if you take a look at investment grade, and we have seen hefty flows coming out of HYG, LQD, for example, this year. And a lot of people have pointed to those tight spreads and said this is a complacent market. But I'm curious, I mean, how your active managers are navigating in that space.
So a couple of things. If you believe the soft landing that I have articulated, then that's a great environment for corporate bonds, so investment grade and high yield, and also securitized credit. So I think that's the first point that I would make. In terms of the spread question, you're absolutely right. If you go look at high yield spreads, they are in about the 5th percentile, so very expensive versus history. However, if you look at yields, yields are actually about the median. So it's this whole yield versus spread. And when I think about investors, they don't eat spreads. You know, yield are what help people in retirement. And when you're looking at 7.5%, 8% yields there, you're
Yeah, I mean, I haven't talked about credit spreads to you guys. I mean, I don't want to overload you guys with bond knowledge right now, but that kind of, man, that is kind of interesting. But I mean, the whole thing is like they talk about duration, and we talked about that at the end of last the Friday show where it was Friday, right? Yeah, it was Friday, and Friday night. And I was talking about I was leaving that whole bond discussion up there. I don't know, maybe people passed out on that, but it's like duration. And the thing I mentioned was that small caps and long treasury bonds are plays on duration. And today was pretty bad for bonds. Now, I'm not sure if it was because of options expiration and it was like something like that, because I don't think there was any news. But yes, we saw TLT drop to a nice low, and that's where I bought some more TMF. Okay, so let me see if I can find what I was gonna do. No, it's not here. Okay. Gotta reopen it again, I guess. Man, that's weird. StreamYard's being a little weird today. Huh. Okay, let me see. Must be this one. Yeah, sometimes StreamYards is a little weird. But here's the TLT. And we've hit this bottom right here. We're in the blue line. We were in this uptrend, this green uptrend going up here. And TLT has hit this blue line. And I bought TMF. TMF is leverage 3x. So I was buying here when it dropped below 50. It tried to recover a bit, didn't make it. So I bought another chunk. So got some here near 50. Got some here again, 48. So I'm going to wait a while and see what it does. Now, if you remember last stream, I was talking about the gold to TLT ratio, and gold is outperforming TLT. And I said during that time, I said, like, we could be in a situation where bonds are just in a range, right? So we're going to stay in this range where TLT is just bouncing back and forth, this range, while gold keeps creeping up for the next at least 6 months, right? Next year, at least 6 months. So one outperforming, but eventually, you know, bonds will have to ease off, because right now what's happening, I played another video last time saying, some bond people were saying, from the Bloomberg Real Yield Show, that's where it came from. It was that people are looking at the elections and saying, hey, it could be that there's a clean sweep for one side and the other. So either Republican or Democrat dominates both Congress and the presidency. So in either case, spending will go up, because it's easier for them to pass bills, right, to increase spending. When they both are against each other, they'll just fight each other because they want to spend on different things. If you're a Republican, you'll still have some neocons. You got some Democrats, you got some neocons that flipped over to the Democratic side there too, but they also have the Green New Deal and all the other stuff. So, you know, either way, there's gonna be like easier ways to introduce bills. They'll send spending going up. So in that case, if the debt starts increasing, then yeah, durations doesn't look good, because then it'll be easier to have inflation because all these guys want to spend more money fiscally. So the fiscal policy will just balloon up. All right. So that's, and the monetary side of it will try to constrain that. So Jerome Powell will have a hard time cutting rates when everybody else is spending. Unless Jerome Powell doesn't give a crap about inflation at all anymore, then yes, who cares? But from that standpoint, that's why both TLT went down and also IWM. So today, IWM went down as well. But of course, that could just be options expiration. And we'll talk about that in the next articles that we'll go through. But first, let's just get through this ETF stuff. All right. And she did mention about credit spread. So I might make a point for you guys that I will discuss this some other time. Credit here. And maybe this will confuse you guys. But this is a credit spread. So these are two credit spreads. This is like triple B credit spread, option index. And when the spread goes up, usually bad things happen. Okay, let's just say that. I'm not going to explain why right now. I don't want to get into it. But on that video, that interviewer, she was asking that lady from JP Morgan, what about the HYG to LQD spread? Okay, HYG and LQD are ETFs. All right. HYG is junk bonds, and LQD are the good bonds, the non-junk bonds. Okay, they give less yield, but they are from companies and things that won't go necessarily bankrupt, right? So, and I think I have a chart here somewhere where I use that as an indicator. I don't know if it's this one. Yeah, here. I think I did this. I use LQD over IEF. I think that's similar. Let me look what the heck IEF is. IEF. Yeah, okay. I did a different spread here. I did LQD over IEF, but I think it's a similar concept. So I did LQD, which are the liquid bonds. LQD, investment grade bonds. I mean, liquid bonds. I mean, investment grade bonds versus the treasury bonds. Okay. So as long as it's going up, I think we're good. But it's been going down since October, whatever. So maybe something bad's about to happen. Not sure. I don't know. Let me see. Let me see how well this indicator even works for something like that. Yeah, sometimes I don't know. I don't know if it really, how much of these indicators are really that good at telling things. But yeah, I think you want the LQD over IEF. But let me look at close these guys. Let me look. HYG. I believe she said HYG. Yeah, I'm right. High yield bonds, okay? High yield over LQD. So I can use that ratio to describe a spread here, right? So, or you could do vice versa, LQD over HYG. Doesn't matter. But let's do a month. Let's do a month, right? So here, starting in 2018, you see the corporate. This is why there was such a big panic during the stock market at that time, because you started seeing issues in the junk bond market. And once that happened in December of 2018, that's when the Fed stopped raising interest rates and QT. So they both stopped raising interest rates and stopped QT. QT being that they stopped unloading bonds back to the open market because they bought a bunch of bonds, which is quantitative easing in the 2007-2008 crisis. All right. So they bought bonds in the open market. So this was outside of their mandate with interest rates. So they did something more than that. They bought bonds. So they bought a bunch of bonds. And I think they also bought some corporate bonds too, I believe. So not only just like treasury bonds, but corporate bonds. But in any case, you see here, like all the junk bonds underperformed the investment grade bonds up until, guess what, COVID. So if you're a conspiracy theorist, you might say like the Fed was screwed. They stopped raising interest rates, but they still wanted to raise interest rates. They had to figure out another way to do it. So what they did is that they took advantage at least of the pandemic. And if it was a plandemic, it gave them a great excuse to restart QE. And then once inflation started pumping, it was a great excuse to reintroduce QT to unwind everything. So you basically shock the system. You shut down the whole world's economy. You create a supply shock. Then you reintroduce stimulus during that time, overinflated that bubble, allowed you to reintroduce QT with high inflation. So it's like someone like, I mean, in another way you could think about it, because you look at Japan, they were in constant deflation. It was such a problem, and they couldn't stimulate their economy up into inflation. So it's always a policy for the Fed to have inflation, and if they knew that they couldn't tighten their money supply without causing a serious recession again, the only way was to create like a artificial recession which was controllable, such that they could game it, that in a way that they could reintroduce inflation so that was also controllable, that they could control in a meaningful way, because they controlled, like, okay, you shut down the government, you shut down all the logistics and the supply chains, and you man, I mean, this is it's too much of a deep thinking thing with the theory here, because I'm not an economist, but it's just my guess, my hunch. I just feel that way, because if you look at these charts, it just tells you the story. Like, something's up, man. So yeah, I'm a chart guy. So charts just give everything in a visual manner that gives so much information. Like this thing, it just gives you so much more information than looking at the news. Like, what's up with this? Why is HYG underperforming investment grade bonds? And you see, like, it was solved. This issue was solved after COVID. Anyhow, so back here, you see here that the junk bonds are nicely outperforming LQD. So this is a way to look at spreads. Yes. So the spreads here are growing back. So this is when the spreads were tightening, and then now the spreads are loosening, and whatever. I don't know. Or is it vice versa? I'm not a bond guy. I can't tell you that what it was implied, but that was what the question was to that bond person. Okay. That's what they were talking about. So this is a proxy for credit spreads, and we can talk about that some other time when I get some articles to read to you guys from people that understand this in a much more clear way, because it's such an important thing when dealing with the bond market. And like I told you, bond people know things much better than stock market people. Nobody would tell you this stuff. But this directly affects you, though, in the stock market, because if you looked at this chart, you probably could figure out, hey, Jerome Powell can't do nothing. He's got to stop. And then once you reach this level, you're like, wait a minute, Jerome Powell's stuck again. What is he gonna do? And then you get the whole thing with the pandemic. Yep. I see now. So like I said, there must be people that are way smarter, that look at this stuff and can figure things out ahead of time. So yes, make a mental note that I'll probably be talking about this some later date. But back to the small caps. So as I told you last time, the big small cap sector is biotech, the most risky of all of them. So yes, it was down today, 1.68%. And we'll see. It's still stuck in this range. We're still in this range. We're still stuck here. So no idea where it's going to go yet. And I think I'm going to show you, before we continue, the Fed Watch tool, which I always use. Always use this. Let me close this. It's going to take up all this memory here. So I'm going to remove that. And remove this. Okay. Here. This is what's happening here. So the probabilities of a cut. So right now, our Fed rate is 475 basis points to 500 basis points, okay? So that's essentially 4.75% to 5%. That's the Fed interest rate that they set. And so far, the probability that we cut is still 90.5%. Now, at the meeting after the next meeting, so the next meeting is November 7th, the meeting after that meeting, December 18th, the probabilities. So 1 month ago, the probability of 2 cuts was 50%. The probability of 2 cuts 1 week ago is now 0%. The 1 cut is now 76.6%. The probability on Friday, 76.8%. See? However, today, the probability is 64.8%. And the chance that we just do 1 cut, or we stay the same, sorry, my bad. When we stay the same from the November cut, so November we say we do 1 cut, is 32.5% from 21.8% on Friday. So I have no idea why that happened. But you saw the TLT drop. Now you see this. So something changed. And I think it's because of the elections. And let's go to this article here. So we're going to talk about the elections now. And then I'll go and I'll circle back to ETFs. But let's look at elections. So there's this website called Polymarket. Okay. So Polymarket is an American financial exchange. And it's the world's largest prediction market, headquartered on the Upper East Side of Manhattan. And it's offering event contracts. So it was launched in 2020, and it offers a decentralized platform where both retail and institutional investors can place trades on various future events, including economic indicators, weather patterns, awards, as well as political and legislative outcomes. So participants can deposit USDC cryptocurrency through the Polygon blockchain network and trade shares that represent the likelihood of specific outcomes occurring in the future. Okay. So now let's go here. I think I don't know if they do it in the. Let me see. Peter Thiel. Okay. 2022. So in May 2022, Polymarket appointed J. Christopher Giancarlo, a former commissioner of the CFTC, as chairman of its advisory board. In May 2024, the company announced that it had raised $70 million across 2 funding rounds. These rounds included investments from Vitalik Buterin, the co-founder of Ethereum, and Founders Fund, a venture capital firm founded by Peter Thiel. There you go. Now let's look. Let's look at this article here. Post that link up for you guys. Peter Thiel's VC firm backs election betting with Polymarket investment. All right. Peter Thiel's venture capital firm Founders Fund is betting on one of the largest crypto-based prediction markets, even as a key U.S. regulator steps up efforts to restrict activity on such platforms. And this was in May 14, 2024. Polymarket has raised $70 million across 2 rounds, with the most recent raise led by Founders Fund, a spokesperson said. The company, which also counts Ethereum co-founder Vitalik Buterin among backers, has been attracting users predicting the outcome of various events with bets on the 2024 U.S. presidential elections, turning into the most popular contract on its platform. The new investment comes on the heels of a proposed ban on trading of derivatives, betting on political contests, and sports games from the U.S. Commodity Futures Trading Commission as it cracks down on so-called event contracts. Polymarket was previously fined by the CFTC and as part of a settlement promised to wind down services in the U.S., continuing to operate abroad. A lot of the reason why certain people don't like prediction markets in the US kind of dates back to pretty puritanical thinking about betting. Joey Krug, a partner at Founders Fund, said about the CFTC's proposal. In the short to midterm, it's good for Polymarket because they are targeting non-US markets. In the long run, it will be good if Americans can participate in this market too. Election betting has drawn the biggest surge in activity on Polymarket, with more than 170 million wagered on events tied to the US elections, according to its website. Former President Donald Trump has even shared Polymarket odds on the likelihood of his return to the White House. Theo, a libertarian who disdains regulation, has shown an affinity for the cryptocurrency marketplace, describing its growth as a rebuke of the world's financial systems. The Polymarket investment is the first that Founders Fund has made in a platform that facilitates event betting contracts, according to Krug. In a bid to repair its relationship with regulators, Polymarket brought on former CFTC head J. Christopher Giancarlo as the chairman of its advisory board months after its 2022 regulatory settlement. So they got some government guy on there now. There you go, guys. This will be the new futures market. So this is what the futures is all about. Futures market. So I don't know if I can get through all the stuff I wanted to cover today because we're almost at 2 hours. I'll try to see how much I can get through within the next hour here. So let me continue on here. Blah blah blah. Yeah, this whole article is pretty useful, so I'll read the rest of the 3 paragraphs. The predictions platform is led by 25-year-old founder Shane Copland and lets users trade topics far beyond elections, such as how many times Elon Musk will post on X or what GameStop Corp's stock will do. Polymarket lets customers buy dollar-backed stablecoin USDC and fund purchases of shares. It doesn't take custody of customer money or digital tokens, and it just displays existing markets on the Ethereum blockchain. A Polymarket spokesperson said that Founders Fund led a $45 million Series B funding round. General Catalyst had earlier helped the company raise $25 million in a Series A round. The new funding values the company with no revenue at the moment at a lower level than previous discussions. The company was eyeing a valuation of almost $1 billion before the CFTC action, Bloomberg previously reported. When we think about the U.S. market as well as investing, researching into it, we know that is likely not something that will pay dividends immediately, Copeland said in an interview. Ultimately, we have the deep conviction that markets on all the things that people are wondering about and have opinions on will exist. Okay. So that essentially is you're turning everything into a futures market. So, and I haven't discussed futures yet with you guys. So that's not something we want to discuss just yet, but I will slowly start introducing the concept, and I don't know if we got time for it. That's what I got to figure out. How much time we have. How much time we have. Okay. Let's see. So I'm going to give you the website here. So this is the Polymarket website. So you can go to polymarket.com and you can see a whole bunch of things to bet on. Put the link up here for you guys to see in chat. And here's their forecast. So 63.6% Trump, 36.4% Trump. And you can still look at the history here. So everything started changing around October 7th, right here. Yeah, October 6th to October 7th. That's when things really started to ramp up for Trump. Now, let me look at all of them so you can look at everything here. Here you can look at Super Bowl stuff. Fed interest rates you can bet on here. Popular vote winner. Electoral college winner. Premier League. Yeah, you got everything on this. Man, amazing. But yeah, you can just do it all on blockchain, all on your crypto. And I guess they said it was banned for US people, so I don't know. If they know you're from the US, I guess you can't. You gotta use VPN or something to get around it. See, pop culture. Let's see what's in pop culture. Number of Elon tweets. The next 007. Taylor Swift engaged. Will Kamala go on Joe Rogan before election? What? Did Ye cheat on Bianca? What the fuck? Diddy sex tape released before November. Oh, this is great. This is great. I like this. I like it. People could bet on anything of this shit. But all right. Let's get back to business here. So the other website uses real betting odds or something like that. What's called real betting odds, election betting odds. Yeah. So the election betting odds uses all the stuff. You got the it uses the poly market, it uses predicted, it uses Betfair, so it uses several sources, but it's about the same. You see, so you got your swing states. You can tell which one's deep blue. So Nevada's kind of like Nevada. You got Michigan, Wisconsin. Those three are light, and then Pennsylvania's starting to get dark pink, like right now. So it must be after the McDonald's stunt, Arizona getting deeper into red now. So you got the North Carolina, Georgia, Pennsylvania starting to turn, and if he can take Michigan or Wisconsin, that or Nevada, like you get one of those, that'll help. But yeah, I think it's very critical to get North Carolina, Pennsylvania, Georgia at this point, and Arizona might be safe for him now, maybe. So unless you get some shenanigans, this is how it looks for the Electoral College. So that's about it. That's all I got to say about that. Let's see. What else we gonna say? Okay, covered that. Covered the poly market stuff. Yeah. That's good. That's good. Now we're gonna go to the ETF. So I think I'm gonna play another video here for you guys. And I don't want to go too far tonight because I might have to leave it for the next night. So we're already at 2 hours, but I did want to cover something about options and things like, or not options. Well, yeah, triple witching. I wanted to cover a little bit. So this was so you remember the video with that bond lady talk about that ETF. So this is when the ETF first came out, probably about 1.5 years ago, about here.
Douglas Jonas, we're live on the floor of the New York Stock Exchange. As usual, making a bit of history this morning, the 20th ETF ever to come to the floor of the New York Stock Exchange, but more importantly, the very first JP Morgan ETF to ever list here on the floor of the New York Stock Exchange with Citadel as DMM. It happened this morning. We just rang the opening bell. Now, for those of you who've been following this, and you know that this has been happening only for a year, the very first ETF hit the floor in November of 2022. We're only a year later. 20 ETFs have come down to the floor. But guess what? Because of that, we can measure everything that happens, what all these individual traders do every single day and provide liquidity for stocks. They're now doing it for ETFs. We have measured every ETF that have come to the floor. Guess what? Spreads, they are down. I have it in front of me, 43%. That's right. The amount of money to cross the bid offer for an ETF drops 43%. Size at the inside, that's the amount of money that's available when you and I want to trade JBND. The size at the inside, that goes up by 34%. But even more importantly, those of us that want to trade in the auction, you want to put your trade in overnight, you want to trade market on close. Opening auction slippage, down 80%. Closing auction slippage, down 41%. If you want those stats, you can find it all on our website, etfcentral.com. But more importantly, we're here this morning with Kay Herr. Kay is the U.S. CIO of Global Fixed Income, Currency, and Commodities at JP Morgan. And Rick Figley. Rick is the head portfolio manager on JBND. First of all, I got to ask you, Kay, what was it like to ring the opening trade bell?
So exciting to be here. Thank you so much. Really exciting to meet Tom and Pete. We're not going to interrupt them. They're busy. Terrific amount of volume this morning on J-Bond. We're excited about being on the floor. We're excited about active ETFs, and we think J-Bond's a terrific product in the core bond space.
Yeah, I mean, only a few months. ETFs is doing exceptionally well in terms of assets coming in. We had a huge opening auction this morning. I want to talk, though, generally about the fixed income markets. I mean, we're talking, it seems like everyone's talking about bonds, fixed income. I mean, put on the crystal ball, if you will, for us, and what do you sort of expect this year for fixed income?
So look, bonds are back. You've got very attractive, geez, I'm not going to ring the bell again. You got very attractive yields in fixed income. You can get 5.3, 5.5% in a core bond actively managed by the team behind us who are taking care of your duration and of your credit risk. We think it's a terrific total return outlook. We think the Fed's going to start easing. We've got a soft landing in an economy. We think it's a great opportunity for real returns, real yields in bonds.
I want to come back to you. Rick Figley, you're the head portfolio manager for JBND. Could you tell us a little bit about the ETF?
Yeah, so J-Bond is an actively managed fixed income ETF that's managed to the U.S. aggregate index. J-Bond is going to take advantage of parts of the index that are underrepresented in the entire U.S. fixed income market. The U.S. Ag Index makes up almost or invests in only about 50% of the outstanding debt. J-Bond is going to invest in securitized securities, but in the entire universe. The attempt is to provide extra income and higher yield than what you're going to find in the index, along with greater diversification.
So for an investor, for an advisor, they say it's JBND, easy to remember, the JP Morgan Active Bond Fund, J-Bond. Where does it belong in a portfolio?
It belongs in your core holdings. This should be a core fixed income holding. When you think about either a 60-40 portfolio, it should be the majority of that 60-40 portfolio.
Okay, I want to come back to you a little bit. We talked a little bit about fixed income, but of course, the JP Morgan entire lineup of ETFs. I mean, you've got a lot out there for investors, for advisors. You know, when you're speaking to your clients, what are you talking about right now in the marketplace?
So look, I'm a PM on both JSCP and JCPB. It really depends. There's a tremendous amount of money in money markets. There's something like $6 trillion in money market funds. With our expectation that the Fed's going to be cutting rates this year, we think it's a great time to lock in current yields. You can get 5.5%, 6% in actively managed bonds. We're going to manage the duration risk and the credit risk for you. We think it's a great opportunity for investors. Also, JPI, if you're looking for more income, JPIE is another terrific offering we've got.
Yeah, I mean, let's just put it out there. The entire JP Morgan suite of ETFs. I mean, is there a spot someone's listening in, they want to learn more? Where should they go?
JPMorganfunds.com.
Easy to remember. And of course, you go to our website, etfcentral.com. Just type in JP Morgan, you'll get the entire suite. Or of course, more importantly, type in JBND and learn about the new JP Morgan Active Bond Fund listed here on the floor. Thank you to everyone who's surrounding us. We got a bit of a crowd around us. Thank you to NYSE.
I can talk about, let's look at what those bonds are. Let's look at what those bonds are. I pull up my browser for you guys, sharing this again. So let's look at it. Let's look at J bond. So this is the JP Morgan actively managed bond ETF. Blah, blah, blah. Accept the terms and agreement. Blah, blah, blah. Hurry up. So it has a SEC yield, 30-day yield of 4.47 to 4.46%. Yield to date, year to date, 4.14% overall performance. So nothing special here, you know. Nothing special here. But yeah, you can look it up. You can look it up. And supposedly this is an actively managed bond ETF. So I don't know if it's like, wow, these guys are really outperforming anyone else. But yeah, if you're a lazy investor, I guess this is okay. If you want to have some bond exposure, you can use this ETF. So put up the link in the chat for you guys. Now, the other one, they talked about JPI. Okay. There was this JPI ETF. So this is JPI. This has a 30-day SEC yield of 6.24%. Year to date performance is 5.75, not bad. So JPI has provided high yield like yield with lower volatility. Okay. So it has less risk apparently, and it gives good yield. Okay. So it's risk adjusted yield. So we were talking about like risk and all this stuff, beta, I think we're talking about. And I did mention about the SEC yield. So what that means is that represents net investment income earned by a fund over a 30-day period expressed as an annual percentage rate based on the fund's share price at the end of 30-day period. The 30-day yield should be regarded as an estimate of the investment income and may not equal the fund's actual income distribution rate. The 30-day SEC yield unsubsidized. Unsubsidized yield does not adjust for any fee waivers and or expense reimbursements. So that's why they got those two numbers there at the bottom, I guess. In any case, it's almost the same. But yeah, you use the SEC yield when you want to take away because these things have a high fee, a percentage fee. Where is it? But still, this yield's pretty good, I think, for the SPIE. So yeah, you can look at the fees are here, yeah. .4%. Yeah, gross expenses, yeah. So that's pretty expensive. That's pretty much. And this one, this J bond, JBND, 0.25% has a lesser fee for less performance, I guess. That's what it is. So yeah, something to think about. You know, there's so many ETFs now. You really could do your own investing. If you have a list of ETFs, it'd be really dumb. So this one, I put the link for the JPIE in there for you guys if you're interested about ETFs. So let's talk more about ETFs. I think that's what I want to discuss today with you guys, because I mentioned this last time. I talked about Michael Burry from the Big Short and the 2007 crash. That's how he got famous. Let me see if I can find it. Oh man. I thought it would be here. Didn't I? Ah, right here. Here it is. So let me put this up here. Yeah, sorry guys, I have so many tabs now. Every time I do one of these things, I got like a billion tabs. The Big Short's Michael Burry explains why index funds are like subprime CDOs. I'll discuss CDOs after this, but let's just read the article. Investor from The Big Short is worried about passive funds. The longer it goes on, the worse the crash will be. For an investor whose story was featured in a best-selling book and an Oscar-winning movie, Michael Burry has kept a surprisingly low profile in recent years. But it turns out the hero of The Big Short has plenty to say about everything from central banks fueling distortions in credit markets to opportunities in small cap value stocks and the bubble in passive investing. One of his most provocative views from a lengthy email. Oh, let me also mention this was September 4th, 2019. Okay, this article. One of his most provocative views from a lengthy email interview with Bloomberg News on Tuesday. The recent flood of money into index funds has parallels with the pre-2008 bubble in collateralized debt obligations, that's CDOs, the complex securities that almost destroyed the global financial system. Burry, who made a fortune betting against CDOs before the crisis, said index funds inflows are now distorting prices for stocks and bonds in much the same way that CDO purchases did for subprime mortgages more than a decade ago. The flows will reverse at some point, he said, and it will be ugly when they do. Like most bubbles, the longer it goes on, the worse the crash will be, said Burry, who oversees about $340 million at Scion Asset Management in Cupertino, California. One reason he likes small cap value stocks, they tend to be underrepresented in passive funds. Here's what else Burry had to say about indexing, liquidity, Japan, and more. Comments have been lightly edited and condensed. So let's just go to the index fund and price discovery right here. Central banks and Basel III have more or less removed price discovery from the credit markets. Basel III. Now, I kind of mentioned Basel IV rules coming in. So there's something called the Basel IV endgame. So in 2 years, they'll completely restructure the regulations for banking to comply to Basel IV. So remember that. So I don't know how that figures into this because he says Basel III is already causing issues. So I don't know what Basel IV will do. So if you think a crash is coming, maybe someone should be researching that Basel IV stuff for us here. Okay. So they've removed the price discovery from the credit markets, right? Remember that. Meaning risk does not have an accurate pricing mechanism in interest rates anymore. And now passive investing has removed price discovery from the equity markets. Okay. The simple thesis and models that get people into sectors, factors, indices, or ETFs and mutual funds mimicking those strategies, these do not require the security level analysis that is required for true price discovery. This is very much like the bubble in synthetic asset-backed CDOs before the great financial crisis, in that price setting in that market was not done by fundamental security level analysis, but by massive capital flows based on Nobel-approved models of risk that proved to be untrue. Liquidity risk. The dirty secret of passive index funds, whether open-end, closed-end, or ETF, is the distribution of daily dollar value traded among the securities within the indexes they try to mimic. In the Russell 2000 index, for instance, the vast majority of stocks are lower volume, lower value traded stocks. So Russell 2000 index, I showed you IWM. IWM is a small cap ETF that tracks this. Today, I counted 1,049 stocks that traded less than $5 million in value during the day. That is over half, and almost half of those That is over half, and almost half of those 456 stocks traded less than $1 million during the day. Yet through indexation and passive indexing, hundreds of billions are linked to stocks like these. The S&P 500 is no different. The index contains the world's largest stocks, but still 266 stocks, over half, traded under $150 million today. That sounds like a lot, but trillions of dollars in assets globally are indexed to these stocks. The theater keeps getting more crowded, but the exit door is the same as it always was. All this gets worse as you get into even less liquid equity and bond markets globally. Now, what did you see? What did you guys see in August, September this year? Japan raised rates. The yen grew stronger against the dollar. And all of a sudden, the S&P 500, the NASDAQ, all took a dump. I mean, yeah, they had that little Hamas, Iran, all that crap happening during the same time. The media hyped it up, but you can see that when liquidity goes away, it's easy to start crashing things, right? Because we got all these people piled in on one focused area. Like Denison only trades in the E-mini futures. E-mini, my bad. Well, is that? Yeah. He just trades the E-minis options, right? Yeah, and SKJ3, like he just does what? The NASDAQ futures, the NQ. So yeah, Denison does SPY options, and CKJ3 does futures on the NASDAQ. So everything's on the index level. And ETFs, the lazy man's way of buying into the S&P 500, or, you have the 401k also, doing the same thing where people just blend in mostly like, large cap growth or something like that. And everything's in NVIDIA now, and NVIDIA is the leader. You saw that? So when some Dutch company last week leaked its earnings, supposedly leaked, and then all of a sudden the semiconductors crashed, and then the NASDAQ crashes, and then the S&P crashes, all in one go. 2%, 1%, 2% for an index. What if it was something more serious? Everyone's crowded into those things, right? So let's continue on here. It won't end well. This structured asset play is the same story again and again. So easy to sell. Such a self-fulfilling prophecy. As the technical machinery kicks in, all those money managers market lower fees for index passive products. But they are not fools. They make up for it in scale. So what is that? The lower fees. So like, all right, the S&P, the SPY ETF, pretty cheap. The VOO, which is even cheaper than the SPY ETF. These things are real cheap now. Potentially making it worse will be the impossibility of unwinding the derivatives and naked buy-sell strategies used to help so many of these funds pseudo match flows and prices each and every day. This fundamental concept is the same one that resulted in the market meltdowns in 2008. However, I just don't know what the timeline will be. Like most bubbles, the longer it goes on, the worse the crash will be. Well, let's see. Oh, so he's talking about Japan here. No, I'm not going to get into that. Yeah. That's. Oh, this is interesting. So back in 2019, Michael Burry was saying betting on water shortage. Well, hey, now we got like AI, Bitcoin mining, all this shit. Yeah, everybody wants water now. So yeah, I sold out those investments a few years back. There's a lot of demand for those assets these days. I'm 100% focused on stock picking now. Not much comment on that, I guess. Okay. All right. Anywho, I'll put the link back up here for you guys. So that's the Michael Berry one. Now let's talk a little bit about CDOs since he talked about it. Let's talk a little bit about the CDOs. So this is the Investopedia article for CDOs. I like using Investopedia. Right, you know that, guys. So collateralized debt obligations, CDOs. What it is and how it works. Collateralized debt obligations represent of a sophisticated financial product that has changed major aspects of the investing world. Born out of the need to spread risk and create new investment opportunities, CDOs have become a cornerstone of modern structured finance. A CDO is a complex financial product that pools various types of debt, such as mortgages, bonds, or loans, and repackages them into tranches sold into investors. Each tranche offers a different level of risk and return, with senior tranches being the least risky, allowing investors to choose the exposure that best fits their strategy. The creation of CDOs dates back to 1987, when Drexel, Berman, Lambert first assembled portfolios of junk bonds into these structured products. Since then, CDOs have evolved to comprise a wide range of underlying assets, from corporate debt to credit card receivables. Understanding CDOs is crucial for grasping the interconnectedness of today's financial system. Understanding CDOs. CDOs are like financial alchemy. They transform a collection of individual loans into a structured product that can appeal to a wide range of investors. The magic lies in how they redistribute risk and return. The earliest CDOs were constructed in 1987 by the former investment bank Drexel, Berman, Lambert, where Michael Milken, then called the Junk Bond King, reigned. The Drexel bankers created these early CDOs by assembling portfolios of junk bonds issued by different companies. CDOs are called collateralized because the promised repayments of underlying assets are the collateral that gives the CDOs their value. To create a CDO, investment banks gather cash flow generating assets such as mortgages, bonds, and other types of debt and repackages them into discrete classes of tranches based on the level of credit risk the investor assumes. These tranches of securities become the final investment products, bonds, whose names reflect their specific underlying assets. For example, mortgage-backed securities, MBS, comprise mortgage loans, and asset-backed securities, ABS, contain corporate debt, auto loans, or credit card debt. That's interesting. I didn't even know that credit card debt was even part of this stuff. That's crazy. Other types of CDOs include collateralized bond obligations, CBOs, investment grade bonds that are backed by a pool of high yield but lower rated bonds, and collateralized loan obligations, CLOs, which are securities backed by a pool of debt and often contain corporate loans with low credit ratings. So I won't go any further than this. You can read this on your own, but I mean, I think this gives you an idea. And ETFs, right? You see what they do. Now, not only are they passive, but they're active. So we have these banks giving you ETFs that are actively managed, that basically sell, buy bonds, or even stocks for you per day. That's what she said, didn't she? She said it like they'll update it per day. They'll put it on their website how they changed their positions, what percentage went to this thing or that thing. So this is pretty interesting, very interesting. And we have crypto too. So the crypto market with with like lots of new technologies. You know, they're trying to create new financial products. You saw with that poly betting website. What is it called? Polymath, Poly Market. Yeah, Poly Market. You see that? That's interesting in itself. So we're living in a new world with even more packaged products and new futures products. So now let's move on to futures. That's what I want to discuss today. And I don't know if I can get through this completely. Okay. Let me see. I'll introduce it with this video. Let's see what I can do. Let's see what I can do, guys. See how far we can go today. Because this might be too complicated.
Of the actual.
Okay, let's go here.
You can simply get. So if let's and we're going to look at in trader education. So let's talk about that. We'll go to this slide. Now, I think I might have done a similar type of podcast well over a year ago, maybe even it was close to 2 years ago. So I figured it's time to look at this again, just because it is part of the analysis we do when we look at futures contracts. And if you're trading futures contracts, you should know what this represents, because it is an important piece of the whole puzzle when you're trading, especially if you're trading commodity type ETFs. It's not quite as important, let's say, if you're looking at S&Ps, the stock index futures markets, and to a lesser degree, even, let's say, the financial, like treasury bonds, treasury notes, etc. So the financial related futures contracts, because those have very deep cash markets and other ways of playing the same type thing. Commodities, there's, other than perhaps GLD, which is the gold ETF, the other ones are much more dangerous to play in and don't really track futures the way you think they do. So let's talk about open interest, what it is and how to use it. Open interest defines the total number of outstanding futures contract commitments that exist at any given time. So if somebody's long in the futures markets, ultimately there has to be a short on the other side. So for each long and each short, you actually, so if, let's say if I'm long a contract of gold and you're short a contract of gold, even though we each have a position, you would take that only counts as one open interest contract. So that's why here I say it's the total number of outstanding futures contracts divided by 2, because each person only represents half of the trade. And in futures markets, unlike stocks and other markets, there has to be a long position for every short position. And that's because in futures contracts, you can, when you trade futures markets, you can simply get into the trade without actually owning the underlying commitment, because futures contracts are the obligation to purchase the underlying contract at the end of the contract when it expires. Every futures contract has an expiration date. The commitment you make when you buy a gold futures contract, let's say right now you buy January gold. January gold is the front month, Feb gold would be the front month active futures contract. So if you buy a February contract of gold, you're not actually owning gold, you're owning the commitment to buy gold at the contract price that you traded it at when the contract expires in February or late January. Could be the date of the actual expiration of the February contract. So it is a commitment to be a buyer at a future date. If you sell that commitment out before the contract expires, you make or lose the difference between where you got in and where you got out. And that's how you make or lose money. 99% of all futures contracts, the people who trade them never want to actually take delivery, or if you're short the contract, make delivery. It is simply a vehicle in which to express your wager on which way the price is going to go. And if you're bullish, you get long, and if you're bearish, you get short. And unless you have 100 ounces of gold for every futures contract that you're short to deliver against the contract, you don't want to be stuck holding the short contract into delivery, because the buyer can say, I want my gold, because maybe they really do want to take delivery of the gold. So the people who are often on the short side are either speculators or they're hedgers. They're people who are in the industry who have the ability to deliver the goods. So for instance, if you're short a corn contract, who's naturally short? A farmer. A farmer uses the futures contract to hedge the price of, let's say, the corn that he or she is growing. And if they have to, they could deliver the corn to the location of the delivery in the contract specifications of where the corn needs to be delivered to at the time of the expiration of the contract. But if you were short a gold, or let's say a corn contract into expiration, you're going to have to come up with 5,000 bushels of corn to the person who bought it and wants delivery of corn. Who might want delivery of corn? Well, let's say Frito-Lay to make Fritos corn chips. They need to buy corn. So they actually are often taking delivery either in the cash market, they just buy corn in the cash market, or they'll buy a futures contract and take delivery because they need the corn. So if somebody is long a futures contract, ultimately somebody has to be short that futures contract. And here's how this all relates to open interest.
Okay, let's stop there. You heard what he said, hedging. So if I'm a farmer, I'm going to hedge. So I'll use futures. Now, gold also hedges. So gold miners will hedge. So that's why I brought up this video. So let's pause this for now. Okay. So let's see if we have enough time to go back to it and continue that discussion on open interest. But maybe not. Maybe we'll have to leave it for another day. But this is the reason I brought this up. Because if you're interested in gold mining stocks, silver mining stocks, you know, these stocks, if they're going to perform well on a rise of gold and silver, it depends on their hedging structure too. So not only the cost of mining, which is based on workers' wages, inflation, and energy costs, oil, natural gas, coal, whatever they use to mine their ores, like what are their here, this is an article. So what are their costs to produce, but also their hedging. So that's also a cost that most people do not appreciate when they buy gold and silver miners. That's why a lot of people get burnt on gold and silver miners. And same thing with Bitcoin miners. Bitcoin miners could also use futures because there's Bitcoin futures. They could be like, oh man, I think Bitcoin's prices are going to go down and I'm going to short Bitcoin using Bitcoin futures to protect myself. So yeah, you could be a producer of gold, silver, Bitcoin, but you will short the actual market to protect yourself because that's business. So shorting, you know, and that's why Righteous Muffin comes on here and says like shorting is evil. Why would you bet on something going down and this and that? You know, there's actually legitimate reasons to short because like in this case, it's insurance. So you are protecting yourself from a bad event. Anyway, I'm not going to go there right now, but you know, so it's not a moral question. People have to understand markets are markets. They're there for a reason. People will abuse a market, either long or short. Some people will pump, make a bubble. Some people will short with illegitimate theses or whatever the plural is, and make up stories that a company is doing something shady when it's not. Yeah, that happens, but that's a human thing. That has nothing to do. It's not that you can't ban like this or that. There are reasons we have options. There are reasons we have futures. I mean, yeah, you see people gambling and stuff, but people are people. Like, you give them a gun, maybe they'll shoot everyone, right? I don't know. So that's why I'm trying to teach you guys why these things are what they are. Okay. How are futures used to hedge position? Okay, let's go to this article from Investopedia. Here, I'm gonna put this up on the link in the chat. Okay, you got that link, right? There you go. Taking it down. As market rise, optimism can paint a rosy picture of endless financial profits. Yet experienced investors know the tide can turn at any moment, transforming today's gains into tomorrow's losses. In these moments of uncertainty, the strategic use of futures to hedge positions becomes valuable for those looking to protect their investments from the ebb and flow of the markets. Hedging limit losses, acting as insurance against adverse price changes. Future contracts, agreements to buy or sell assets at a future date for a predetermined price, are often used for hedging purposes. This is because they allow investors to lock in prices and take offsetting positions, effectively securing against the unpredictability of market movements. Whether the goal is to safeguard stocks, bonds, or commodities, futures provide a way to manage financial exposure and mitigate risk. Below, we demystify the principles of hedging and show how futures fit in. Okay, let's go. Understanding hedging with futures. Let's say you have built a comfortable retirement portfolio that primarily tracks the S&P 500 index. Or you are a large commercial corn producer planning to harvest several tons in the fall. Or you're a portfolio manager with a significant position in U.S. Treasury bonds. In investing, we call these positions, that is, the particular asset held in your portfolio. Your positions represent a wager on the future direction of that asset's price. A position is either long, where you benefit from a rise in the asset prices, or short, where you profit from the decline in value. Just as you need insurance against the hazards of driving or horrendous storms, you might need to hedge your positions to ensure market changes don't wreak havoc on your finances. The value of your positions can fluctuate wildly because of economic changes, political events, or shifts in market sentiment. Okay. For your retirement account, a negative turn could mean you have fewer funds that you need after your working days are over. For the agricultural producer, you might not get the prices you need on this year's crop to plant the next one. For the portfolio manager, poor returns can impact the finances of many who rely on your strategic choices. Hedging is a safeguard to reduce or offset the risk that prices will move against you. For example, taking an opposite position in a futures contract can protect your investment from losing its value. Suppose you hold a long position in stocks. You might hedge by taking a short position in S&P 500 futures contracts, thus insulating your investment from a potential decline in the index. A futures contract is a standardized financial agreement between two parties to buy or sell an asset at a specified price at a future date. These contracts are traded on exchanges worldwide and can cover a wide range of assets, including commodities like corn, financial instruments like stock index, or government bonds. Futures are highly versatile, allowing you to tailor them to the specific need of the hedger. They let you to lock in prices for the future, providing predictability and security in an otherwise uncertain market. All right. The most basic type of hedge using futures contracts is the forward hedge. This locks in a price today so that the future prices don't create an unwanted loss. Let's imagine for an example from two professions that are as old as trading itself. The farmer who grows wheat that a banker transforms into bread. I mean, a baker. Banker, I just read banker. That a baker transforms into bread and confections to feed a community. We'll see how going about their business requires the strategic use of hedging with futures contracts, where both parties want to lock in prices today to keep them producing into the future. We'll now turn to see how they might use short and long hedges in wheat futures. Short hedge, the farmer's shield against financial disaster. Our example begins with a farmer planting winter wheat in the late fall. This wheat is not just a crop, it's the farmer's savings resulting from much labor and contains hopes for a future livelihood. However, the farmer knows that the price of wheat at harvest next summer can change according to the whims of the weather, blight, a sudden bumper crop that increases everyone's supply, and countless other factors. The farmer uses a short hedge to guard against the risk of falling prices, which could turn a season of hard work into financial hardship. A short hedge involves selling future contracts for wheat. When the farmer sows the fields in October, the price of wheat is $600 per bushel. The farmer calls a broker with instructions to sell wheat futures that expire in June, so they coincide with the harvest. The amount needed to cover the expected harvest is about 5,000 bushels. Moving ahead to the late spring, the price of wheat has fallen to $500 per bushel, which would have been a loss of $100 times 5,000, so $500,000 for the farmer. However, at harvest, the farmer also buys back or lets expire the short futures position, which is a gain of $100. A gain. I said red grain, which is a gain of $100 times 5,000. The farmer effectively locked in the price of $600 against his wheat crop at planting. What would have happened if the price of wheat had risen instead to say $700 per bushel? The farmer would still have locked in the $600 price. The physical wheat would have increased $100, but would have been offset by an equal loss in the short futures. That's the price of using futures. The farmer guards against risk while limiting the profits that can be made. That's a very good example. I hope you guys understood that. But you guys can read the article again and read that over and over if you didn't get that. But the idea is you're locking in the price. So Master Kim came on here like yesterday talking about oil and the refineries in California and all that stuff. That's why these markets are complicated, really complicated. So these examples are very simplistic. But if you're very sophisticated and you have a big business where you have tons of farms to manage, tons of crops, and you have to look at all the possibilities of weather, like pesticides not working, shit like that. Labor, even labor, right? You could have like labor issues. You can't get enough people to harvest the crops, like all kinds of stuff. These things are very important to consider. So, that's why I never got into business. Like running a business is not easy. And farming is even worse. It's like nobody wants to be a farmer in the end. My dad was a rice farmer, and that shit wasn't fun. And I don't think Vietnam had futures markets. All right, let's go long hedge. The baker's protection against rising costs. While the farmer is planting, a local commercial bakery estimates its needs for the following year. The head baker worries that Should the prices for wheat, a key ingredient, go up, that would squeeze the company's already low margins and perhaps even cause some layoffs. To mitigate this risk, the company opts for a long hedge. Okay. The long hedge involves buying futures contracts a day against a future purchase of an underlying product or asset. At the start of the financial year in October, the baker estimates it will need 10,000 bushels of wheat. If wheat would just say stay at $600 a bushel, the bakery would have a tight but manageable profit margin of 10%. Given its relatively large workforce and the money it's poured into new commercial ovens and delivery trucks, the baker buys futures expiring in 12 months, representing 10,000 bushels of wheat. By October of the following year, wheat prices have fallen to $500. Rather than seeing added profits from the lower price of wheat, they still end up paying about $600 a bushel because losses in the long futures contracts offset the lower cost of wheat. However, if the price had instead risen to $700, almost a 17% increase, the bakery would have had to lay off workers and scale back operations. The hedge protects these jobs and keeps the company from going into the next year by allowing the $100 per bushel profit in the long futures position to offset the higher wheat prices. Very good example. So you saw both sides of the trade, and both sides benefit because they're not using it to gamble like me. I'm a gambler, right? I want to trade. I want to know where wheat's going to go, up or down. But people are actually using this for real reasons. And this is what you have to understand. That's why the market is. The market is not you, the gambler. The market is actually useful for people. Okay, let's go back to the video.
If a new long comes into the market, what's a new long? Somebody who has no position comes in and buys a contract. We use corn as the example. I come in and I decide corn is going to go up. I want to get long a corn contract. That's a new long for me. If the person on the other side of the trade is a new short, let's say a farmer who wants to lock in the price of corn, he becomes the seller. That's a new short for him. In that case, when a new long matches up against a new short, open interest goes up by the amount of contracts that we bought and paired against each other. If I want to buy 5 contracts, somewhere in the corn market, by the very fact that I buy 5, somewhere there has to be a seller of 5. And ultimately, the seller either is a short, and well, let's assume at the beginning it's a new short. So if I buy 5 contracts of corn and a farmer sells me 5 contracts of corn, so he's short the corn, open interest goes up by 5 contracts because I'm a new long versus a new short. When 2 new players come in, you have open interest go up. They're on opposite sides of each other, but open interest goes up. If an old long is getting out, so let's say I previously bought corn as a new long, but now I want to get out of my long, so I'm now a seller. And the person who's buying the contract that I'm selling originally was short, and now he's buying back to cover his short. We're both exiting our positions. Open interest goes down by the amount of contracts that we've just transacted. So if I had previously bought 5 contracts of corn a month ago, and now I want to get out, I sell out. Let's say the person who had sold corn to me a month ago, it doesn't have to be that exact person, but let's say somebody who was previously a short is getting out by buying and covering their short, then we're both leaving the marketplace. Open interest goes down by the amount of contracts that we've both transacted. But there are several transactions that take place where open interest doesn't actually change. So for instance, and these are in the yellow bullet points, a new long comes in, but the person selling to me is not a new short. It's somebody who was previously long who's just getting out. In that case, open interest doesn't change. A new long comes in against somebody who previously got in who's simply getting out. Now it's a new player versus an old player exiting. Open interest doesn't change. A new short coming in who's selling the market, if they're selling, they need a buyer. Who are the buyers? Either new longs or somebody who was previously short who wants to cover their short. If a new short comes in selling to a prior short who's covering and getting out, open interest doesn't change. If a prior long, somebody who had already bought, is selling out to a new long who's coming in, the new buyer is coming in to establish a new long, but the person selling used to be long, they're not going short, they used to be long, then in that pairing, open interest doesn't change. And if a prior short is now going to buy to cover their short, and they're a buyer from a new short, so you have one who's exiting coming into somebody who's just starting a position, open interest doesn't change. So what really matters, net is new longs versus new shorts, and old longs exiting to old shorts exiting. Those are the only two ways that open interest either moves up or moves down. How does that relate to a market? Let's take a look at here. Let me pull up. Let's start with here, gold. Now here's the price of gold that we normally look at, but what I want you to look at is this line here. When I put up volume, when I have a futures contract, it also gives me the open interest. So what's this tell us? Well, we'll kind of spend a little time looking at this, and we might end up spending more time going through open interest today and far less time going through individual chart analysis. This is to really teach you about open interest. Recently, we saw open interest go from just about 500,000 contracts to 600,000 contracts. And then it came right back down to 500,000 contracts. Well, what happened here? In this particular move that was in early November, which associates to this week here, this at least, let's say 2-3 weeks here. Let's blow up price more so you can see. Gold had started to move up quickly, and it kind of broke out, and you had a whole surge of new longs coming into the market. We also had a new surge of shorts coming into the market. How do we know that? Because open interest went up. So the buying of new people coming into the market who bought the breakout to get long. Now, some of the buyers were also shorts getting out, but if a new long comes in against a new short, open interest moves up. Well, open interest went from 500,000 to 600,000 contracts. That's a 20% rise in open interest on this breakout. So lots and lots of new positions came in, both those from, let's say, speculators buying the breakout, but on the same side, you had new shorts saying, I'm very willing to be a seller of this breakout. Again, who are those shorts likely? Could be hedgers who are putting on new positions, or those who felt that even though this broke out, maybe it was a good time to sell. Let's just say, let's look here. If we go to the all-time high and we go here, well, look, you even had a breakout this way, but clearly somebody was very willing to be on the other side of the trade to put on a new short, not somebody getting out of an old long. There were some in that, but the fact that open interest went up means we had new longs versus new shorts. Now, when it's up here, you don't necessarily know that this is going to stop, but quote, smarter money did, because this came right back down, right? The price of gold ended up with this false breakout. Now, we had a 13 here. We kind of had some idea that this may not be lasting. And when we do the chart analysis, we see we had a 13 followed by a move that essentially fails against its propulsion full exhaustion level here and a prior propulsion exhaustion.
Okay, what he's describing now is DeMark counts, and I want to get into DeMark some more. I kind of introduced it a little bit I don't know if it was 2 weeks ago or 1 week ago, but I briefly mentioned it. It's going to take some time to talk about it, I think. But I don't know. Yeah, if I'm gonna do it tomorrow, I might try to do it tomorrow. Some more introduction to this, but bear with the discussion, because like what's important is the open interest, and there'll be some more like discussion with that. I have some Jake Bernstein, some Larry Williams. Like he talks about looking at the open interest and the commitment of futures traders report. So this is well-known topics for futures traders. They'll look at, so if you do commodities, you got to do that stuff. So that's your insider knowledge. Well, not insider, but that's your secondary indicator, is to look at those things when you're doing commodities trading, like gold, like silver.
Caution level. So you've got some reasons to not necessarily think this breakout's going to truly continue. It ends up, the market comes right back down. And look what open interest did. The same 100,000 contracts that came in left the market, which means you had people come in and then people got right out. So the buyers came right out, and who'd they sell out to? The shorts who had come in there covered up quickly. So here you see that the move up and the move down matched with the move in open interest, which means you knew new longs came in. Initially, the shorts who came in against those longs were losing money. But then when the market turned around, the shorts were making money and the longs were losing money. And both ended up getting out. And we know they both got out because open interest came right back to where it had started from. So that's one way of looking at open interest. Let's look at this. Here you have, let me bring in more price data. So what happened here? Gold is in this bull leg. We're going, this is 2019. It's rallying from a base near $1,250, $1,300, gets a big breakout, and open interest is moving up sharply. What's that mean? It means new longs have come in and new shorts have come in. It has to mean new shorts came in because someone has to be on the other side of the market, and the people who are selling to the new longs are either old longs getting out or new shorts. We know net, they're new shorts because open interest went up, and the only way for open interest to go up is when new longs offset against new shorts. So what's going on here? The longs are making money, the shorts are getting squeezed, right? They're losing. What's interesting here is that midway into this rally that ends up going to all-time highs up here in the summer of 2020, open interest is tailing off. So even though there's buying, open interest is going down. What's that mean if a market's moving higher, but open interest is going down? It means that old longs, which could have been from who knows when, but at some point, once we got above, let's say 1600, somewhere in here, old longs are getting out and old shorts are getting out. Yet the market still moved higher. So what do you have? A huge short squeeze. The shorts are paying up to the longs who are getting out. And that creates this massive squeeze, and eventually we get a high. Since then, if you look at, then the market sells off, but open interest stays, well, no, we've got some jag move here, but let's look, since all-time highs, we went sideways for half a year in open interest, even though the price basically came lower. What's that say? Well, if open interest isn't changing, then we know we have old longs getting out to new longs, and or old shorts getting out to, let's see, old shorts getting out, so they are buyers, to new longs coming in. Wait, did I say that? Old shorts, now they're buyers into old sellers getting out. This is a yellow bullet point. No change in open interest, even though the market slid. That's gold. Let's take a look at, I don't know if silver will be much different, but let's take a look. And not much here. Let's look at copper. What do we see here? Or actually, we'll continue this when we do our first episode in January, because we've used up almost all our time. Let's take a look here. Look at copper. Copper open interest has been fading in this somewhat sideways move we've had. So what's that mean? It means both old longs are getting out to old shorts. So the shorts have paid up and can't take the pain anymore. The longs have decided to take profit. In between there, we've gone nowhere. So there are people getting out here without making a heck of a lot of new commitments. How do we know that? Because open interest is going down. People are leaving the market, right? Old longs have said, I don't want to be long anymore. Old shorts have said, I can't take the pain of being short anymore. I want it out. So after this huge run up, open interest moved up and now it has slid in a sideways pattern. That means people are exiting on both sides, which means they really don't know. The longs are content to be out. The shorts say, I've had enough. We will continue this into the new year. Have a great holiday.
All right. So, I mean, that gives you some flavor of how you read it. I mean, that's pretty complex in a way, but yes, you need to understand. So that's just a little taste. A lot of these guys, they become very experienced about how to read futures and things like that and trade them. So a lot of boomers did that in the old days. That was the game. That was the game to play because futures offers you that nice tax benefit, and most people have margins accounts when they trade futures. And nowadays, you got that prop trading like CKJ3 uses, so you don't even need to use your money now. So you don't even need to have margin accounts where you just pay like a few dollars per contract for like a 500 ounce of gold. You get that extra leverage from that. Hey, now you got people actually pay. You just put a little bit of money, and these guys will give you the rest of the money to trade with the prop trading firms that CKJ3 says. So if you're really an advanced trader, yeah, go for it. Go for it. But yeah, that gives you a little taste of futures trading. And the reason I brought that up was because I was talking about gold miners. Okay, initially I was talking about gold miners. So let's bring up this article. Bring this article up. And I might continue this discussion into tomorrow with the gold mining and hedging. So this is the link. All right, here you go. I put up this link. Here you are. Gold miners enjoying record prices are wary of hedging their bets. Gold prices are trading around record highs after climbing about 20% since early October. This is March 17th, 2024. Record high gold prices are driving big deals and investments in new mines. What they aren't doing is making companies hurry to lock in prices as protection against the market suddenly turning down. Hedging, a practice that helps to guarantee a certain price for future output, is common among producers of commodities ranging from copper to natural gas. But it has been eschewed by the gold mining industry after companies got caught on the wrong side of trades made during previous bull runs, as by the precious metal. In 2009, Canadian giant Barrick Gold bought out unprofitable hedges at a cost of more than $5 billion. So, with spot price gold prices hitting a record intraday high around $2,195 a troy ounce on March 8th, and increased interest rates making hedging more attractive than it has been for a decade, the question was whether big miners would blink. The answer, few did. Our policy is very clear. We do not hedge gold, said Tom Palmer, chief executive of Denver-based Newmont. Newmont is going to report earnings Wednesday, remember that. The world's biggest gold miner. In 2007, Newmont spent $578 million to buy out its hedge book. When gold goes for a run, we get the full advantage of it, Palmer said. The combined hedge book of gold miners rose around 10% in 2023 as gold climbed to new highs. according to preliminary estimates from the World Gold Council. But at roughly 192 metric tons, total hedges remain negligible compared with the bets the industry once placed. At the start of the 2000s, the gold mining industry reported hedges totaling around 3,000 tons. Signs of gold miners hedging are closely watched because of the impact it has on global supply. When miners unwound big hedges before, it helped stoke a rally in gold prices. A return to hedging would likely have the opposite effect. Most new hedges agreed in recent times are mandated by lenders to guarantee returns from new projects and typically span a year or two instead of a decade. Jim Bear, chief executive of Regis Resources, a roughly $1 billion Australian gold producer, recently signaled relief at ending an onerous hedge book agreed years ago at roughly half of today's gold price. If I can borrow some words of the very talented Freddie Mercury, we wanted to break free. Bayer told an analyst last month after spending about $65 million to buy out the hedges. Many miners say their shareholders invest in gold precisely because they want exposure to swings in the precious metals price, and that hedging damps this. All right, read that again. Be very clear. Be very clear. The reason why gold miners, silver miners, all those miners don't perform back in the day as well as gold and silver was because of this hedging. And guess what? They don't want to do it no more. And so this time around, we're going to have a rally in gold and silver. These miners, some of these miners are going to get a really big boost. Really big boost in prices, I think. So watch out, guys. If you guys want some serious money from the gold and silver rally, you should just start buying miners. And if you really want the exposure, you can buy options, buy some leaps on some of these miners. So coming through next year, these things could be real big winners. So let's read that paragraph again. Many miners say their shareholders invest in gold precisely because they want exposure to swings in the precious metals prices, and that's hedging damps this. We see investors do want exposure to gold. So the more unhedged we can keep that exposure, the better, said Jay Klein, executive chair of Australian gold producer Evolution Mining. Not all gold miners abstain from the practice. Australia's Northern Star Research Resources, a $10 billion company, hedges about 20% of its production. It recently added some opportunistic hedges to take advantage of higher prices. New York-listed Anglo Gold Ashanti said it put some hedges in place to help manage the risk of high costs at its Brazilian operations. Evolution also has some hedges designed to guarantee a return from the expansion of gold operation in Western Australia, but it isn't looking to add more, even if prices fall. Our view is that the best hedge to a gold price decline is a low cost of production, said Klein. Gold prices are trading around record highs after climbing by about 20% since early October. Analysts say falls in treasury yields and US dollar weakness partly explain the rise. Both typically move in the opposite direction of two prices of gold, which is dollar denominated and pays no income. They also cite ongoing geopolitical concerns, with gold viewed by some as a haven from volatility and demand for bullion and jewelry in China. A recent rush by a number of central banks to buy gold has played an important role too. Miners are using that windfall to build and expand mines and to acquire rivals. A number of companies have sought to invest in assets that also produce copper, an industrial metal that is considered essential to the energy transition. Analysts widely expect gold prices to remain elevated this year, at least, supported by expectations the Federal Reserve will begin cutting rates. That's what they did, improving the metal's appeal. Others question whether the rally can continue, as high prices might damp the appetite of central banks and others to buy more. The next test of whether gold miners regain an appetite for hedging will happen when gold prices appear to trend lower and executives fret about maintaining profitability, said John Reed, chief market strategist at the World Gold Council. Circumstances change, and so do shareholders. All right. So I think that is enough for now. So let's go back to the charts. Let's see if I can run this without crashing the computer. Man, StreamYards has ate up all my memory right now. That's why, after you run StreamYards for 3 years, it's just like it just kills everything. Holy crap, there's no more memory. Wow. All right. Let's see if this I mean, I don't know. I wanted to end with charts, but I don't think this is gonna open. Good Lord. Unless I have to log off StreamYards and come back later. Yeah, what's up? Yeah, I had to reboot StreamYards. It's impressive how much memory it takes after 3 hours of playing. That was like, wow, that's impressive. It's like 6 gigs. So it went from 2 gigs to 6 gigs. Yeah, man. I don't know. StreamYards is so bad. I cannot believe it. I mean, I was gonna end the stream anyway with the last chart stuff, but had to kill it. So come back, do the charts. Let's end this properly now. Wow, some people really don't know how to do memory management, and this is what happens when you run stuff through a browser, right? That's what they do. They don't want to make their own app. They're too lazy to do their own coding, I guess. That's what happens. That's exactly what happens. So let's see. Blah, 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 blah. What the heck? Where is it? Oh my god. Oh man, I'm so annoyed. And we're paying like $900 for this now per month? Are we kidding? I mean, bro, that ain't worth it. Okay, let's go back. What else I talk about? So I want to talk about gold miners. So let's look at the index. Gold index. Gold, silver, mining index. Okay, here. Divided by gold. Let's do a monthly. So this is a ratio of gold, silver miners over gold. So for the most part, since the 2008, yeah, pretty much 2008, yeah, it's been in downward trend. So gold miners, silver miners have not performed as well, compared to gold. Let's see. Let's do silver. Let's see if there's any difference. No, same thing. Yeah. Pretty much. Yeah, it's in a downtrend. It was a downtrend earlier, 2000, probably 2004. Yeah. So compared to silver itself, yes, underperforming. So that's why most people, they don't like the miners. They rather buy the futures for, if you want leverage, you just buy futures for gold and silver. But things are a changing, I think. I think things are changing because I like it. Looking at EXK, man, already up. Let's see. These are nice green candles, 28%, and now 30%. So from last month to this month, oh boy, beautiful move. From around 2, so I got an average about 2 something here. So between the $2.50 and $3, so I probably average cost basis is $2.83. Now we're at 5. Nice. So I sold some here. in EXK. Okay, so this is Endeavor Silver Corporation. So really nice. And yes, I think we're going to have to watch this ratio carefully. So gold, silver. So we're going to have to look at this ratio and see if it pops. It's been going sideways since 2015. So yeah, not bad. So another stock I wanted to talk about was Zim. Doing nice here. So it had a breakout today, $8. It looks like it's a breakout. So we finally recovered. So we had that drop. And now we recovered. And we're back where we started from September 30th. Now it's October 21st. So I feel like, yes, this is looking good for shipping containers. So for at least for the West Coast. And this is a West Coast specific Israeli company, West Coast. shipping container company. So yes, we have almost liftoff. My target for this is around $45 to $50. That's the initial target. But after that, maybe we'll get to $90 again right here. Plus. And they give fat dividends. They give really huge dividends. But I mentioned this yesterday. No, not yesterday. 2 days ago when Jay Rillo was here talking about like taxes. Yes, you have to pay it double tax. You get taxed from the Israelis on dividend, and then the U.S. will tax you again. So even though you get a nice fat tax, yes, you will get screwed because of the taxation. And I'm not here for the dividend. I'm just here for the dividend will be a bonus, but I'm just here for the price appreciation. I want this to go up. And then I mentioned earlier in the stream about quantum computing, so let's go over that quickly. Quantum computing, IONQ. So this had a PR. Let's see what the PR was. Public release. Press release. IONQ announces largest 2024 U.S. quantum contract award of $54.5 million with United States Air Force Research Lab. This was September 27th. IONQ's trailblazing technology has grown quantum into a substantial growth business. The company is expected to nearly double its revenue for the third year in a row. Deal accelerates IONQ expansion into the $15 billion quantum networking market. Okay, and you guys can read more about it here. I'll put the link in the chat. Okay, and you guys can read that. But yes, this stock looks like we've hit our resistance here, because this level was set way back when, like probably around here to here. So we're now in this range. We're entering this range. We're trying to enter. So I think there's going to be a big fight here before we can continue. Okay, so watching this stock. Now the other ones in this space, quantum computing, is D-Wave Quantum, QBTS, the ticker symbol, watching that. And Quantum Computing Incorporated, QUBT is a ticker symbol. So here is a much weaker looking chart. So yeah, there is one. We still haven't entered that range yet. So we're still watching. So watch that too. And these two guys, QUBT and QBTS, they're definitely penny stocks for sure. They are in the dollar range. They are really bad. But we'll see. We'll see how things go. And in related penny stock, speculative stock stuff, we have Mind Medicine. So this is shrooms, acid, those psychedelics. So we're going to look at this. MNMD is the ticker symbol. So I looked at this area. It bounced off. So it didn't go into this range. This March 2024, March 4th, 2024 news was because the FDA approved one of their drugs. So it's pulled back half of this whole huge run up from November 2023. So we're back here. So all that FDA news stuff was faded. So let's watch. This could be the start of another run, because it used to be a $50, $60 stock. So yes, if these small caps really do well, definitely I'm looking at this. The other one is CYBN, Cybin Incorporated. This is an uglier looking chart, but recently it started popping to September. Went up 20% here, 16% in another week in October. So 2 big growing weeks. We'll watch this. It's got decent volume, so there's definitely something going on. Definitely watch it. Now the trashier names in the psychedelic world. Atai Life Sciences, ATAI, ugly looking chart. I don't know. I mean, all you can say is like it's at the bottom, maybe. Like, can it go lower? That's like $1.20. We have Compass Pathway, same issue. It's at the bottom. Okay, you can buy it, I guess, just because it's at the bottom, but doesn't mean it's going to go anywhere. Maybe CMPS, and yeah. So those are the two. And I'll look into this Sable Offshore Group. So this might be interesting. Definitely, if it's an oil play, yeah, it could be interesting here. It's definitely moved quite well, so it has that beta. Very good. Very risky, though. So, yes, definitely we'll look into that. All right, guys. It's about 3 hours, 25 minutes. Now, remember, we have the Halloween contest. So, remember, the rules are here. I put it up there. It'll be October 31st, 9 p.m. CST Central Time. And we got about $655 out of $1,500. So we need that $1,500 and we can have all this. And if you guys put in money, we'll match it. John and I will match it and we'll try to push it up. And that means we could have extra shows on this where after we do the 3 hours, we could have a 4th hour where we do like the second place and first place go against each other for another set of prizes. You know, we could really expand this, man. We're gonna make some brackets. Hell, we could have like some bets on the side bets going on too. Like if we get more money, we could start thinking about that. But hey, I don't want to give Portia any pressure, but think about it, guys. Things are gonna go well if we get more money. More money, the better. All right. So I'll see you guys next time. Tomorrow, maybe I'll do 2 shows next time to try to get through all this futures, and because I didn't get to options. I wanted to talk about the options stuff. Because I want to talk about Monday effects and things like that, but no. This is too much for one night. I think you guys need a break. That's why I have to do these streams, because there's so much stuff you have to learn, man. I mean, yeah, you could just focus on charts, I guess that, but you know, we need some education here. You guys got to know the basis for things, and then we can move on. So anyway, I'll see you guys later. Man, I gotta find my StreamYard. Where the heck is it? Where is it? Oh, I lost my StreamYards. Oh, here it is. Here's my tab. Okay, now I can end it. Good night.